Hit it.
It's Friday, April 7th, 2023, episode 210. I'm Patrick Ceresna.
And I'm Kevin Muir. This week we have the pleasure of welcoming two guests to the show. Will Nutting, author of Nut Stuff, returns to grace our airwaves with his great stock picks and unique macro views. And he brought along his pal, Rupert Mitchell, also known as the Blind Squirrel, who regaled us with his stories about his career, from starting at Barings just a few months before Nick Leeson bankrupted it, to his working for one of China's largest electric vehicle manufacturers. And just like Will, Rupert has got a bunch of stock picks that he shares with us. After that, it's time for Patrick's Talking Charts, where he attempts to make sense of the topsy-turvy action of the past couple of weeks.
We'll end with our no stupid questions and skin in the game. And folks, we might even drink some beers along the way. So stick around. We've got a great show. Lena, hop on. What beer am I drinking this week?
So Patrick is drinking Chela de Playa Penguin Brut IPA.
Yeah, it's a 6.5% Brut IPA. You know, this is important to know which beers are Brut, because for dry January, I only drink Brut. Anyway, that's a horrible joke. Okay, let's keep going. But it's a great Mexican beer. Let me give it a try here. Oh yeah, it's gonna work. Anyway, give us
Let
a
me do
disclaimer.
the side effects. Get this all over with. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include SpaceX sinkholes, orbital overdrafts, and Fibonacci fidgets. I think you suffer from that last one all the time.
Way too many. Way too much. All right, let's get to the interviews.
Well, folks, we have a little bit of a special occasion here at the Market Huddle. We have two guests that are going to join us. The first is a repeat offender. He has been here before, and he was none other than Will Nutting, author of Nut Stuff. And Will, the last time we had you on the show, it was September 2021, and you had a little interesting observation about where the S&P was.
Yeah, the S&P was 4,400 versus, 4,100 or so today. And it was kind of it was 2 months before the travel ban was lifted, I think, to the US in November 21. And I only know that because my children live in America and I hadn't seen them for the best part of 2 years. So it was a special moment, actually.
And it was like almost like nothing's happened since then.
Well, I mean, if you looked at a lot of stocks, correct, but I think if the XLE has doubled since then. Coal stocks, tanker stocks, have all gone bonkers and crazy. But quite a lot of stuff hasn't been that interesting.
Right. And then joining us as well is a new guest to the show. It is none other than Rupert Mitchell, aka also known as the Blind Squirrel. And he's the new author of the Substack, The Blind Squirrel Macro. Rupert, thanks for coming on.
Thanks, Kev. Been a huge fan of the show for a long time. Delighted to be on.
And why don't you two just kind of tell me your relationship between the two of you and how you guys got to know each other and how you work together as it is now?
Yeah, sure. I mean, so Will and I actually, turns out we were at school together, but we didn't know each other then, and got to know each other through mutual friends several years ago, and through a common love of the markets.
And Kev, I mean, I sort of, it was almost like we were both kind of playing golf and we had different clubs in our bags. Rupert has very much a good macro club and a great feel for the macro and the trading side. And I guess I'm a nearly 30 year equity guy and with a big bias to the US. And so it was just really interesting sort of playing golf on the market golf course. And our different clubs were kind of pretty complementary. So we just talked and compared our different views of how we approached all the sort of daily, weekly, monthly challenges of the markets.
And we've got this weird kind of time zone advantage now. We probably speak every day, if not twice a day. And I'm over here in Australia. Will's sort of flitting around the hotspots of Europe on a day-to-day basis. And we cover the time zone quite effectively.
Well, that's right. We have quite the international show going on here. We're taping this Wednesday afternoon, and it's 4:00 where I am. Will has stayed up to time is it there in Switzerland?
I'm dressed in my dinner jacket in Switzerland. It's 10. What is it? Just after 10 o'clock at night. 10:30 at night.
And Rupert just woken up.
The video is firmly off at 6:30 a.m. in Melbourne.
All right. So listen, we've learned last time a little bit about Will's background, and let's take a little bit of time to learn about Rupert's background. So Rupert, you guys mentioned you went to school together. You're obviously from England. Where did you go to university? Did you always think you wanted to be involved in markets? I'd love to hear your kind of backstory.
I guess quite a lot of Brits, I was a completely accidental banker. I read French and Spanish literature up at Durham in the northeast of England. And the merchant banks, as they were called in those days, used to come up to the universities to do what they called the milk round or graduate recruitment. And I found myself in the only 5-star hotel in Durham, drinking free beer in the company of blokes wearing red braces and striped shirts. And the next morning found myself in a first round interview. And so that would timestamp that would have been back in 1993, 94. So I started at Barings in September 94, and we went bust in February 1995. I guess it was an early lesson in the dangers of vol selling for me.
All right. So
with Leeson that was shorting Nikkei straddles that took down Barings for £400 million. It kind of put Silicon Valley Bank in perspective.
Right, and wasn't that the world's oldest bank that had they took down?
Yeah, I mean, it's amazing. So I think Barings was probably about 200 years old. I think the Rothschilds might have been around for a bit longer, but they've been around for a long time. And Barings Securities was the sort of the buccaneering emerging market stockbroker that was strapped onto a 250 or 200-year-old merchant bank. The combination was explosive.
I was looking through Nick Leeson, the famous story, and I didn't realize that he was martingaling it. So not only was he selling straddles, but he was, in essence, when he had a position that went against him, he just kept doubling it up until
absolutely. I mean, he went classically on tilt.
That's right.
It all happened. I mean, obviously, the biggest day on the calendar at an investment bank is bonus day. And essentially, it was bonus Friday, and Barings went bust over that weekend. And I was a complete squid. I had no idea what was going on until my phone rang in my flat in London on Sunday morning, and it was my father. And he rang. He said, "Are you all right?" So what are you talking about? And I said, "Well, looks like Barings has gone bust." I said, "Don't be ridiculous." And I hung the phone up. Half an hour later, my mum calls the home phone. And this time it's quite irritating. I had a little bit of a hangover. I'd just been celebrating my first ever city bonus, which was a princely £400, and had quite a big Saturday night. And when my mum rings again on the Sunday and she says, "I've just seen the terrible news. Are you going to be okay?" And I said, "Oh God, not you as well." And I staggered down to the front door to see a picture of my office on the front page of the Sunday newspaper. And I guess the rest is history. I did make it onto the front page of a national newspaper myself. I mean, I think that's
you did
first and only time.
You were actually on the front, like for the Barings bus, like you were the famous story of the $2 bill on the Bear Stearns.
I wasn't quite sort of carrying a box of papers out of the front door. No, they put some paparazzi up on the fire escape outside the corporate finance library, and we got packed through the window. And so, as a general rule, bankers try not to get onto the front page of the newspaper. As a general rule, something's gone horribly wrong if that happens. But that was the only time I was ever on.
Kev, it's quite funny, but it's quite funny and ironic because fast forward many years to 2008, and I was working at Lehman Brothers. So in many respects, Rupert and I both had the experience of working for old, well-established firms that with a bit of humor
go tits up.
Trouble.
Well,
and I always remember arriving at Lehman Brothers when it was first, highlighted having problems. And it was quite interesting because there was an Aston Martin salesman who used to be allowed up onto the trading floor. and he'd wander around, see everybody, and get orders for cars. And it happened to be that one of the days when the rot was beginning to set in, the car transporter from the Aston Martin dealership turned up with 7 Aston Martins on it. And of course, all the press were outside, and someone very intelligently told the driver to go and park around the corner.
He brought 7 to this is
No, not me. They weren't mine. But on the trading floor, it was the group order from the trading floor, and they happened to deliver them on one day.
Oh gosh.
So I mean, you could just you
can't make
think
that
about
up.
how crazy the world. Yeah.
You know what? Maybe though, you guys have both been at shops that have gone bankrupt. It's like that old joke about this man who says, was talking to his wife, and he says, you stayed with me when I had my heart attack and nursed me back to health. You stayed with me when I went bankrupt from my failed business. You stayed with me when one of our kids died. And I'm beginning to think that maybe you're just really bad luck.
Well, actually, Kev, I sat next door to a lady at Barings when we went bust, and she had been she'd worked at both Kidder Peabody and Drexel Burnham Lambert before starting at Barings.
Oh my goodness. Okay, so let's see. So you're at Barings. You get through that. Where do you end up from there, and how does your career evolve?
So I mean, I stayed at Barings because I don't know if you remember, they were bought by ING for £1 famously.
Oh,
and
okay.
I was 6 months into finance and kind of didn't really have anywhere else to go, so I stuck around. And the reason I joined Barings is because I wanted to do emerging markets, and specifically because I was a Spanish major, wanted to do Latin America. But about 6 months after deciding to stay on, Deutsche Bank, who were Deutsche Morgan Grenfell in those days, literally stole the Barings Latin American business across 12 countries. I think it must have been 60 or 70 people over the course of one weekend. And so my dreams of going to join the Latin American corporate finance team in Midtown Manhattan sort of disappeared overnight. And I plowed my furrow doing sort of European-based emerging markets for the next few years. So banks and cement companies in Egypt and hyperinflationary banks in Turkey. There were some fun times.
And then from there, you eventually end up in Asia.
Yeah. So Asia continued to be a bit of a flagship franchise for Barings. And when the currency crisis came across the tape in 1998, Hong Kong Central Bank, the HKMA, ended up owning 10% of the stock market when they intervened against an attack on the Hong Kong dollar, US dollar peg there. And I had been doing a lot of privatization work over from London, and the team in Hong Kong decided that they really didn't want to allocate any team to working for the Hong Kong Central Bank on a project that was likely to take 1 to 2 years. So they'd better find some poor schmuck in London to come out and to do this type of work, which would involve writing, lots of memos for civil servants, etc., and things like that. So having never been to Asia before in my life, I found myself packaged off to Hong Kong, literally on sort of 36 hours notice to work for the Hong Kong Monetary Authorities, for the Hong Kong Central Bank.
Okay, can you tell us the story about like why they did that? And because it's kind of fascinating. People don't we hear about Japan buying some stocks, the Bank of Japan buying some stocks on their balance sheet. But here it is, they actually owned the Hong Kong, was it the central bank? They own 10% of the market cap
I mean, basically, if you recall the Asian currency crisis, it was kind of a sort of a kind of daisy chain of currency crises, starting with Thailand and going around and up to Korea, and eventually, like sort of a pack of jackals, the vigilantes came for the Hong Kong dollar peg.
Okay.
Now, what is it from The Wire? When you come at the king, you better make it count, or whatever the expression is. They hadn't bet on the tenacity and aggression of the Hong Kong Central Bank, the HKMA, and they executed one of the most perfect short squeezes on the hedge funds that you've ever seen in your life. They overnight banned short selling and then acquired 10% of the market. And I'm not talking about 10% of the free float. I'm talking about 10% of the market, and created one of the most epic short squeezes you've ever seen.
How did they do that? Did they buy futures out on the board in the open?
No, they bought stocks like, you used to be a program trader, right? So
Yeah.
they literally just bought a basket of the Hang Seng. So what's quite funny is they ended up with not so uncommon these days, but in those days, sort of basket trading and ETF trading was almost completely unheard of. But they bought an almost perfect basket of Hang Seng.
Okay.
And funnily enough, the
like they just went out and bought it on the board.
Bank.
Like they just bought program after program, wave after wave of buying.
Yeah, they just went out to all their brokers and just bought everything was there, and the squeeze was something phenomenal.
Okay, and then they had to manage it, and that's where they needed your help.
Then you've got a problem, because all of a sudden you've got the government owning 10% of Hong Kong Shanghai Bank and the telephone company and a bunch of property developers. And all of a sudden, how they get out of it becomes a little bit political. And when I was sent over from London, I think part of my job was to, one of the projects that I'd worked on while I was in London was to restructure some strange animal called an exchange-traded fund. Barings had an emerging market index, and there was an ETF on it. And at that time, ETFs were not commonplace. I mean, spiders existed on the S&P, but otherwise they didn't really exist.
Well, I'm going to have to, one second, Rupert, I'm going to have to interrupt you. The Toronto Stock Exchange actually had one. We were ahead of spiders.
You guys are always ahead of the curve.
Okay, but nobody cares. We're ahead, but nobody cares.
Sorry, Kev. Talk to the hand. Anyway, so the Baring Emerging Market Index ETF was trading at a stupid discount to NAV because all of the underlyings were so illiquid, et cetera, et cetera. Anyway, so part of my job was to I'd had to restructure that while I was in London, and part of my job being sent out to Hong Kong was, according to my bosses, to persuade the Hong Kong Central Bank that they absolutely didn't want to sell down these stocks via an ETF.
Oh, okay.
So we, Barings, had been appointed alongside Goldman Sachs and Jardine Fleming, which was the other great British merchant bank in Asia, which is now part of JP Morgan, had been appointed by the Hong Kong government to advise them on what to do with this. And we thought that this was going to be a sort of a spree of block trades, exchangeable bonds, all sorts of good high fee earning potential transactions. And we were somewhat crestfallen that the HKMA wanted to do a boring ETF and sell it to retail, and we didn't think it was going to work. How wrong could we have been? Because we managed to sell $4 billion worth of this.
Oh, really? Oh, yeah. Wow.
I mean, we worked on this for about a year out there, and all of the deal team at the time was going, I don't think this is going to work. But we were still going through the motions. We were spending a fortune on a retail advertising campaign, et cetera, to try and make this happen. And it wasn't until literally the last sort of 72 hours that it looked like this thing was coming together. And obviously we all patted ourselves on the back and said what a genius idea an ETF was.
All right. And so then do you end up going and making the leap to Goldman Sachs from there?
Well, no, I had a much more circuitous route. So from Barings in Hong Kong, I joined Salomon Brothers.
I didn't realize that. Yeah, okay, and you Salomon Brothers in Hong Kong, though.
In Hong Kong, and at that time, the Asian market was a bit of a weird place. I mean, China. It's hard to believe right now. China was less than 10% of what we did. Most of what we got up to was in Southeast Asia, it was in India, and it was in Korea and Taiwan. And at that stage now, you've got the sort of tech bubble going on, or in the process of imploding. And so we got the tail end of tech silliness in Asia. I mean, I remember advising wait for it, a steel e-commerce company that they needed to actually not show a profit on the bottom line because otherwise we wouldn't be able to do their IPO. And
They weren't spending enough, right? If you showed a profit, it means you weren't spending enough.
Well, absolutely. No, mate. If you show an earnings number, people want to put a multiple on it.
Oh, that's right.
And then you've got to get to a really, really big number in terms of the multiple.
That's right.
Then and there was some great sort of IPO stories like Li Ka-shing's biotech company, which was where the chief science officer was called Professor X, and we actually had to put Professor X in the prospectus. It was all too top secret. And then the IPO for the Hong Kong Macau Bridge, which wasn't then built for another 20 years.
Okay, so you're a Salmon Brothers, and then what does, I guess, I was doing sort of regular equity capital markets by then, but I then sort of started running the convertible bond business for Salomon out there. Okay.
And that's where I sort of really fell into derivatives. So I love convertible bonds, and they're kind of like the sort of Swiss Army knife of financial products, because you've got to have some vol knowledge, some credit knowledge, some equity knowledge, some rates knowledge, and so it's the perfect generalist product.
Right.
And I remember at the time these Taiwanese technology companies started issuing 5-year bonds with 0 coupons and 5% conversion premiums. I said, what witchcraft is this? Who's giving them this free money? Well, obviously, a 50 vol option is worth quite a bit, so you can afford.
Actually, why don't you take a second to explain that to people, because I think there's a lot of times, I remember during like 2021. There was some 0 coupon convertibles getting issued, and everyone was like, "Oh, look, they're just giving money away for free." And that kind of nuance about the the volatility.
0 is much more commonplace now, but this was back in sort of 2001.
Right, but why don't you just explain to people how they work, and so
essentially, in good old fashioned times, a convertible bond used to be priced. The coupon on the convertible bond used to be priced with reference to the dividend yield on the underlying stock. Until people correctly took the view that you need to look at a convertible bond completely differently in 2 parts. You've got a bond that gets redeemed at maturity, and you've got a call option on the underlying equity, and you need to value both independently. And if you've got a highly volatile Taiwanese tech company issuer, the value of a call option at a relatively low conversion premium is actually pretty significant. So you can afford to sell the bond component at a much steeper original issue discount, which translates into a headline coupon on that convertible of 0. But I remember looking at it as a banker for the first time going, how on earth is this possible? But obviously it makes sense once you do the mathematics.
All right, so you're there, and do you start running a pro book, or is this just to do banking business?
No. I'm the new issue guy. So I'm working sort of hand in hand with the traders, just charging around Korea and Taiwan, trying to persuade issuers to raise paper through us. And that sort of really spawned my interest in the derivative side of life. And I found myself back in London in 2003 with Citi, working behind the Chinese wall, so in what was called corporate equity derivatives, where we did option hedging, employee stock option program hedging. We also did the convertible bonds as well. We also did a lot of margin loan type business. And because it was derivatives and because it was Europe, I sat on a desk of French people. I mean, even the people that weren't French pretended to be French.
You know what? The non-Europeans won't get that joke. Why don't you tell people why they're...
Basically, in Europe, anyone with anything to do with derivatives is French, because, I mean, there's a good reason for this, and I think the French teach mathematics very well. But every single derivative desk is essentially a small French colony, even in London.
Kev, I remember Kev. It's funny because I worked at Fleming's and I used to have to go and get coffee for a chap called Cliff Benfield.
Yeah.
And Cliff Benfield was one of the great traders of Japanese convertible bonds. I always remember going over to the desk one morning and delivering the coffee, and there was a deep and extensive conversation about what the best swimming pool chemicals were to put in swimming pools. And I remember at the age of 20 thinking that clearly the equity derivatives desk and the convertible bond desk were in a different scale of earning to the equity desk. And I scuttled back to my desk, not able to contribute remotely to the swimming pool chemicals conversation.
And slightly pissed off that it was you buying the coffee, I guess.
Of course, exactly. How the world has changed.
Okay, so you're still at Solomon at this point, which is now turned into Citi. What makes you go to Goldman Sachs?
Oh, mate, you've got 2 more steps after that.
Oh, so my goodness, you've been too many shops. Rupert. Okay.
So I was in London, and then, I mean, fast forward a few years, well, actually, just prior to the financial crisis, I was asked by Jefferies to help set up their capital markets business in Europe, in London.
Okay.
So literally about 5 minutes before the GFC kicked off, I left Citi to join this scrappy startup that no one could spell the name of, called Jefferies. And I mean, I continue to be a fully paid up member of the Rich Handler fan club. I think it's a great organization with some terrific people, and it was a great place to hide from the GFC ad. But eventually the GFC took its toll. I mean, I don't know what it was like in Toronto, but working in finance in London during the financial crisis was soul-destroying. Even the bank tellers at the building societies were getting a hard time from society. I mean, so a building society in the UK, it's kind of like a savings and loan. So, I mean, you could be a bank teller and you're getting a hard time for being in finance.
Really?
Compare that to New York, where basically everyone was okay provided you didn't work at Goldman Sachs. Whereas in Hong Kong, actually the property guys kind of feel sorry for the bankers because they work a lot harder and get paid a lot less. So the calling of Asia came back, and I fled GFC torn London to get back to Hong Kong in 2010 to rejoin Citi.
Okay. And what were you doing there? Back to the old job again?
So back, my role out there was running the ECM syndicate originally for Citi. So I was looking after all of the block trades and IPOs and convertible bond issuance for Citi from Japan down to Bombay.
Okay. So actually, if I could interrupt here, because I'd love to talk about how a big bank deals with risk. Because you're dealing with risk, and I remember one time, I think it was Jim Carson that we had on the show, and he said that the S&P 500 is the central depository of risk, and he argued that everyone came to there to hedge stuff. And I remember after listening to that show,
right? And I've spoken to him about it.
All right. So why don't you walk us through kind of how a big bank goes about doing blocks or new issues, and how much you use the S&P 500. Just kind of give us a little bit of color about that experience.
Well, I think that risk managers at large banks only really have one dial, right? And that dial is how long or short the spoos am I? And it can be really frustrating when it's your P&L that's being messed around with. But a lot of the business, particularly at that time that we were doing, involved us taking down large blocks of stock from private equity companies or from, billionaire founders or from governments. And
so let's just imagine we have one of these. So let's just walk it through. So the private equity company, he's your client. You keep talking. You know that they eventually want to sell this block, and then they say, okay, this is it.
He's your client until he becomes your counterparty.
That's right.
Right. And
That's right. And so eventually he phones you up and says, I want a bid.
That's the uncomfortable game of the capital markets banker is, all your clients are ultimately counterparties. And you've got a number of audiences that you need to keep happy. Well, your client / counterparty, your institutional client base that obviously want paper at a reasonable price, and your risk managers that want to ensure that happens cleanly without you losing your shirt. And,
right.
Things can go horribly wrong. And I think, this is something you and I have talked about before, is that I'm almost allergic to being short volatility, and being an underwriting large blocks of stock is the perfect definition of being short vol.
For sure. If it's a good price, the clients take it all from you. If it's a bad price, you own it.
Exactly. and your upside is,
a commission.
150 basis points of commission, right?
So
it's classically mispriced risk, and it's the kind of thing that institutions would only do with other people's money, i.e. shareholders.
Okay. And so when you do a block, and let's just imagine, do you have to do S&Ps right away, or it depends on if it sells or not?
So, essentially, this is the other stressful side of the job, is that, to get permission to take the risk internally, you've got to have a pretty good idea of where you think the market is, which is, a process of having nuanced conversations with the street about where the stock is going to clear. Now, Everyone on the street has a pretty good idea, because if Goldman's been making the call, Morgan Stanley's probably been making the call, and Citi's been making the call. So, if you're a large hedge fund in Hong Kong, you've got a pretty good idea of what's coming down the pike. But ultimately, there comes a point 20 minutes after the close where you, as that syndicate manager, are along the risk, and the risk manager probably leaves you alone for the first couple of hours. But as the evening ticks on, and you've still got an awful lot of stock still to sell, you start to get that phone call along the lines of, what percentage of your potential P&L am I about to blow on SPOOS protection?
and they would just buy puts as opposed to selling SPOOS short. I guess so, because
they used to just short the futures outright.
Oh, they did. Okay.
Typically. And so oftentimes you'd find a situation where you lost on the deal and on the short.
Of course.
Because it never worked the other way around.
That's right. Okay, and then so from there, you eventually
there are lots of silly jokes about gardeners and hedges.
That's right. They're Japanese. The only perfect hedges in a Japanese garden. So from here, you're still at Solly at this point, or Citi. And what makes you make the final move to Goldman Sachs? So,
most people try and do their swan song on the sell side by sort of ending up at HSBC or one of the French banks. I decided to do it at Goldman Sachs instead. It essentially in Hong Kong, it's a small place that involved me doing a very similar job about 300 yards away from where I'd done the very similar job at Citi before.
Right.
But it was having competed against Goldman my entire career, I was always curious about what it would actually be like to be there. And funnily enough, it was remarkably similar to my previous job.
Oh, it's not
so a little bit disappointing from that perspective.
And eventually you end up at an electric car company. And I'd love to hear that story. But before we do, let's get Will back into the conversation. And up until now, you've worked in Hong Kong. Obviously, China has been an important aspect as your career has evolved, and it's been at the forefront. But Will's got an idea about value stocks in China that I'd love to hear. So, Will, why don't you tell us your idea?
Well, it's always useful and interesting. And, with Rupert having had his experience on the, on the capital market side, I was the guy sitting on the desk who had to take all the stuff that him and his intelligent people created and then we had to shovel it down the pipe to the clients. But I think, I think the backdrop with, China and value is really more just trying to really work out where the market is. And I think that involves having to step back and kind of slightly look at where we've come from the last time you and I spoke. And we find ourselves in this sort of strange situation where, the geopolitics are really escalating to a huge degree. Even today, I think it's for the first time in 10 years, a Russian warship has just docked in a Saudi port for the first time in 10 years. So you've got lots of stuff going on in the Middle East. But when it comes to China, I guess it's trying to work out for me in terms of alpha, where the opportunities lie. And when I look at the makeup of something like, the MSCI index, for example, so you look at the MSCI All World Index, it's just really fascinating to see the massive dominance of North America. China's 3% of the index now, and it was only really the weighting was actually 1.5 until they included the China iShares in it. And we'll talk about maybe, some of the other emerging markets, later that are tiny bits of the index. But I guess when you look at China versus the West, and I'm not a China expert, and Rupert, I'm sure, can chime in here, having lived much closer to China than I have. I look at a country that had some significant challenges and issues, but as a result of the geopolitics, some of those are being solved by having a much closer relationship with Russia now, which, is a wider conversation. At the same time, how they dealt with COVID and coming out of COVID, they clearly have not got the inflation problem that the rest of the world has had and has had to deal with. And they have very high savings rates. And I think consequently, if you look at what's going on with Macau, you look at what's going on with the airlines, you look at what's going on just generally in a resurgence of activity. And you suddenly start to look at the old favorites of Alibaba and JD and such like. You look at the Macau names, Sands China, etc. These are stocks that a lot of fund managers have been entirely comfortable not owning. And as ESG Article 8 comes in, and the socially responsible and the corporate governance, the G of ESG, becomes an increasing issue for a lot of pension funds and fund managers. I think for the active manager and the brave manager, there is an increasing opportunity, especially as all the FANG stocks have gone off like a rocket, having been very poor performers last year. So I just come at this from a case of, really there are crowded bars and there are uncrowded bars. And Chinese equities, to me, are kind of the music's just beginning to start up. The lights are just going on. And everyone in the bar on the other side of the road, that have been partying like rock stars, a few people are beginning to look across the road and go, hey, maybe, the drinks are half the price over there. Maybe we should go and have a look. Maybe the next party is going to be
Do you worry about,
so that's really,
do you worry about the let's just say, what happened in Russia in terms of the kind of risk of ruin in terms of geopolitics, making your investment all of a sudden worthless overnight? Do you think that Western managers can afford to take that risk with China?
Well, the answer is you're very clearly the jury is out, and obviously people are looking very closely at the Alibaba reorganization and the degree to which the government will take stakes in the individual companies. But I think, as I say, I talk to, China experts, which I'm not. I think Xi, having really now got his position very, very strong and effectively, whatever he is, president for life, it seems as if the embracing of capitalism is very much back to the.
I'd go a bit further, Will. I think the Chinese are almost better capitalists than the Americans. God, that's going to wind a few people up. But I mean, I think that if you look at there are a lot of people that say extreme things about, oh, I could never have any dollars invested in China. They have no respect for capital. Actually, I think what they're doing is just deciding that the stranglehold by the tech billionaires probably isn't that healthy and needs a bit of reordering. Whilst you're never going to have all your eggs in that basket, and frankly, if you look at wealthy people in China, they don't really consider themselves to have wealth until they've got some of it outside of China. But I think your point is fair. I mean, I think,
and again, Kev, I think you go back to the geopolitical overlay, and I think, I don't want to downplay it, but I think the tectonic plates of looking at, I think one of the best investment themes I've seen, and I'm going to credit Kirill Sokolov at 13D with this, was, what he calls the alliance of the aggrieved and the resurgence of the colonized. And I think when you think about what's going on with the world, you think of an entitled and indebted West meeting energy, commodity-rich, vibrant countries with exploding populations. And then you look at where the weight of the market is.
Oh, yeah.
You look at where the weight of assets are. I think that is, in essence, the thematic that, to me, underpins why I suspect that, just as with the E and the S of ESG being dialed back, I suspect the G will get dialed back for the reasons that Rupert's alluded to, which is actually, I think you will see that the Chinese will be very good stewards of people's capital.
All right. Rupert, so from your kind of
I got a real job after banking.
Yes, that's right. You switched in Hong Kong, and you went to after Goldman Sachs. You went to an actual real company that actually does something that does more than just living off the buying and selling of others. Why don't you tell people about that experience, why you did it, and then why from there tie it into your pick that you've got in terms of your trade idea that you've recently published?
Yeah, sure. So, after 25 years of investment banking, I actually got a real job and spent 3.5 years as the chief strategy officer of an electric vehicle startup that was headquartered in Shanghai called WM Motor. And so I weekly commuted backwards and forwards pre-COVID between Hong Kong and Shanghai. It was a really fascinating experience. I mean, having been a generalist finance guy for 25 years, where you are basically always an inch deep and a mile wide, spending full time in an industry, and sort of getting sort of proper vertical knowledge was so much fun. Really was so much fun. But working there, I mean. Just to sort of timestamp this was, I started there in late 2018. I think Tesla had one of its near-death experiences at that point in time. And then things started to really go bonkers. I think, and this would have been about, the beginning of 2019 when, out of the blue, Tesla raised $1 billion of equity, and it all looked as though they weren't going to go bust after all. And then that amazing re-rating process started. As ever in China, there was, and actually China had been taking vehicle electrification a lot more seriously than the rest of the world for quite a period of time at that point. The industry was completely taking off. I think while I was working at WM, there were about 180 companies that were calling themselves an electric vehicle startup. I mean, the market was intensely confusing. But as you pointed out, Kev, the other day, I wrote up a trade idea to be long Mercedes-Benz Group as my play on vehicle electrification. Now, one of the things that one of my roles at WM was to engage with all of the foreign investors, and the classic questions used to come to us: well, what are you going to do when the Germans come? And we used to be very full of ourselves and say, well, they haven't made the investments in the electronic architecture. They haven't embraced the world of the connected car and all of the tech aspects. They are wedded to their distribution mechanisms and won't be able to migrate to direct sales. They have underinvested in autonomous driving, and the new consumer is going to want a new brand for the new electric vehicles. Well, I reckon I was probably wrong on all 5 counts. And if I look at what Mercedes has done, particularly with its more recent pivot to luxury, you've as you will have seen in the note, on all those 5 points, they've more than answered the doubters. And at the same time, you've got the potential for a pure play luxury car company to escape the sales multiple value trap that car companies always end up with. I used to look at a lot of comparable companies tables in terms of valuation when I was at WM, and mature OEMs used to trade at between 1 and 1.3 times forward revenues, right? Going out 1 or 2 years. And there's only one real exception to that, and that's Ferrari, that trades at 8 times. But with Mercedes migrating to being a sort of a pure play, because they're literally in the process of dropping all of their entry-level luxury positioning, I think there's a real chance of them playing in the sort of more of the luxury multiple stakes. So you've got LVMH at 5 times sales and Ferrari at 8 times sales. I don't think they're going to go all the way there, but they could start to bridge that gap.
What are they now?
Playing that via a strip of call options.
And so, sorry, can I just interrupt you before? Well, I'll let you talk. I just want to tell people, if you want to go find that article, just go into your Google, type in Acorn Ben Graham electric car, and it's the first thing that comes up. Will, you were going to say?
Yeah, Kev, I was going to say this is interesting where Rupert and I work together, because I think we both agree the thematic. I think Rupert, by his own admission, having worked in an electric car company, isn't a car guy, and I am a car guy. And I think we, when you look at Mercedes, we both came at this from a different angle. I just came at it from the point of view of looking at the AMG brand, but also, again, looking at macro thematics and working out, that there's somewhere between 150 and 200,000 people in the world with a net worth in excess of $50 million, which is really crystallizes the whole global luxury business, how concentrated it is. So when Arnaud at LVMH says he's just got to sell more expensive stuff rather than finding new customers, that tells you what it is. And that's exactly what Mercedes are doing. And I come at this with VW, I think, as a very credible stock to run alongside, with a huge dividend yield. And when you look at Germany, Germany has about a million people working in the car industry. So I don't think I buy, as with ESG, I think you're going to find a gradual rollback on the concept of phasing out, all the internal combustion engine vehicles by 2035. I don't think that happens. And again, when you look at VW, who obviously own 34% of Porsche, they own Lamborghini, they own Bentley, again, hidden inside this business, I take the point that Rupert would say, which is that there's quite a lot of kind of low-end Golfs being sold at VW. But when you look at the embedded value of these businesses, and okay, Lamborghini sitting inside is trading at about 7 times sales. It should do. It's got much higher margins than Ferrari even. But then you look at where global consumption is ramping, and you again look at the Middle East, you look at Bentley in China. I think you can take a look at consumption, and you can take a look at these stocks, and these are global, high quality global bear moths that feed into this consumption theme that is going to continue regardless of whether the recession that everyone continues to want to talk about happens.
Yeah, and I guess the other elephant in the room that we haven't really talked about is the value chain. I think both Will and I are both long up to the gills in terms of copper and other sort of green metal type exposures. But I think the other ways of playing EVs are actually quite hard. If you look at the battery supply chain, the lithium market looks pretty tricky right now. Nickel is really an Indonesia play. Cobalt, well, that's terrifying from an ESG perspective. And then if you look at the battery manufacturers, you've got CATL in China, which is the 800-pound gorilla of the market. But really, it's become a sort of tool of geopolitics or industrial planning as far as the Chinese government's concerned. So I'm not sure that there are better ways to play vehicle electrification.
Can we talk about nano, Rupert?
Yeah, absolutely. No, this is great, Kev. I've spoken to you about this before. This is the Canadian battery play.
All right.
So I was alerted to this by actually two managers of all the bigger alternative energy funds in the UK, and this is a company called Nano, and it trades at NANOCN in Canada. They're headquartered, I think, just outside Vancouver, and they're basically a $350 million spec sit play on batteries. But what's fascinating is they've had huge strategic investment from Rio. So they've got a locked up mineral supply chain. They've got big partnerships with two of the major Western cathode manufacturers. So that's BASF and Umicore. And it seems as if sitting inside Canada is a world-class EV battery play with a tiny market capitalization that ultimately is a royalties business that most Canadian fund managers know nothing about. So it's something I focused on quite a lot in Nut Stuff. We've done quite a lot of work on it. We've published, came up with ideas. It's incredibly volatile. But I think, they are setting themselves up to be a very, very big strategic partner. And I think it's super interesting, and it fits in with mine and Rupert's kind of thematic on this.
Well, there you go. I'm going to let you guys actually do this next topic together. And you decide how you want to discuss it, because I think you're both on the same page. And that is agriculture, commodities.
Yeah, I mean, I love ags. I mean, I think my big thing on agricultural commodities is for the 2020s is that, I mean, for years I think people have felt it's kind of safe not to really understand what's going on in ag. I don't think it's an elective discipline anymore. I think that this is, you've got a world that's just become a lot more complicated through geopolitics. I think the weather situation is something I want to spend a little bit of time on as well. But food security has just been massively highlighted by effectively Russia and Ukraine. One of the biggest bread baskets in the world suddenly being at risk of closure or semi-closure. I have some exposure to fertilizer companies in my book, and I think as Will does as well. But I published a piece back in February where I was taking a sort of 9-month exposure to the broader agricultural commodities sector through Invesco's DBA ETF and a strip of call options on that. I guess the out of consensus view I was taking there is, and I've been accused of weather pornography for this, is
we love weather pornography.
I always joke and say when the trader starts talking about the weather, you're in trouble.
Well, I'm not talking about natural gas this time. That's the normal home of weather porn. But there is a school of thought that sees a combination of the Tongolese volcano eruption last year, a delayed transition to El Nino from La Nina, creating some pretty extreme potential drought conditions in major growing areas around the world. Now, this is absolutely not priced in the market right now. I'm not saying it's going to happen. I actually, from a personal perspective, hope it does not. But I have positioned this trade around DBA in the event that it could.
Do you have any a view to add there, Will?
So, interesting enough. So, Kev, I mean, I've again, I want to sort of go a little bit more off piste here, which is to go back to what I said about, the parts of the world that I think are underrepresented in the index. And this takes me actually to Saudi Arabia, which is, I think, 0.44% of the MSCI All World Index. And inside Saudi Arabia, you have the third largest company in the world that most people couldn't name. But you also have a company which is Saudi Aramco. But you also have a company there called Madden. And Madden is about $160 billion market cap. They have 4 business areas, but they're also one of the biggest producers of phosphate in the world. And so when I think I try to look at, interesting areas, I have to say I defer to Rupert a lot on weather porn and the ags. But I just sort of, again, come up with something that I think is a little bit off the beaten track, that is hugely leveraged. And of course, when you look at the Middle East and you look at what's going on with hydroponics and them having the space with next generation irrigation technology, it's extraordinary to see how much next generation agricultural technology is being deployed in the Middle East. And so, again, I think just trying to get to people to focus a little bit away from the traditional areas and more towards areas that are underrepresented in indexes.
All right. And speaking of commodities, Rupert, one of your other themes is to buy what you call the lucky country. And it's not just lucky because you moved there.
Yeah, I know. Australia's win, obviously. I moved down to Melbourne from Hong Kong just over a year ago today. And I have been Aussie dollar curious for most of the past year. And particularly since everything kicked off in Ukraine. I mean, if you look at Australia, it is the friendly commodity producer in the world from the eyes of the West. And you've got, at the same time, you've got a currency which is trading in line with the SARS, COVID, GFC lows. You've got a situation whereby Australia probably has the largest pension fund industry, the super funds, as they call them, which are massively invested overseas with a population of over 65s that's going to grow by 50% in the next 10, 15 years. So you've got a currency that's going to have a constant underlying bid to it. Now, I haven't.
And why don't you explain to people why there's going to be a constant underlying bid?
Well, as these boomers retire, they're going to be drawing down on their pensions. And a lot of these pension assets are overseas. So as those funds get repatriated, there's a constant underlying supportive bid to the currency.
Okay.
Now, I haven't pressed the button yet, and I'm in the process of writing this up right now because we've had this, like in many other places, we've got very, very hot inflation down here in Australia, and we have probably the most dovish central bank in the RBA out of any of the sort of major Western central banks. And the property, the problem here is the property market. I mean, residential real estate, I kid you not, is a religion down here in Australia. And politicians and central bankers are absolutely terrified of doing anything to upset the residential real estate market. So we've got a situation where inflation may stay out of control, and we're watching this like a hawk. At some stage, this is going to be a 3 to 5 year trade for sure, if not longer, which you want to structure with as much possible leverage. But between now and probably September, which is when Philip Lowe's term is up as head of the RBA, it's probably time for just inching in, I would suspect. I mean,
because he's too
you're
loose.
You're a massive fan of paying Japanese rates, but the other big widow maker in this part of the world was shorting Australian banks.
Yeah, I know. The hedge funds try to do it here with Canada too. By the way, our TD is the world's most shorted bank right now.
I saw that.
Yeah.
It's amazing.
And people there's so many people getting it wrong, and they're talking about the fact that they're buying this FHN, which is another regional, and they're saying that that's the ARB. And the trouble is they're paying cash for it. So there's no natural arb unless you're just taking a bet that a directional bet, or that TD's going to buy this and it's going to cost them money, therefore I'm going to be short. So it's kind of shocking to me how they've gone and picked on TD, that in their big Schwab holding. It just makes it, I think that people looked at it and said, okay, what do I want to short? I want to short something big that I'm not going to get in trouble.
It feels too easy, doesn't it?
Oh, it feels like, yeah, they're going to get their face ripped off. That's what it. Will, I'd love to talk about this topic of AI, but before I do, I just want to tell you something, a little side story. In one of my trading groups, there's every now and then your name comes up, and you have a group of fans. They literally, I see very learned, well-respected gentlemen saying things like, "Oh, this Will, he goes under the radar, but you should really listen to him."
There must be
tech.
another Will Nothing. Yeah.
Yeah, I think.
And they talking about how you really know your stuff about the semi chips and technology, and they think that you're underrated, a gem amongst a lot of noisy stuff out there on FinTwit. So with that kind of backdrop, why don't you talk to us about AI, what you're seeing there, and if you want to talk about anything about the chips or anything in technology, I'd love to hear your opinion.
Well, listen, I mean, I think when it comes to technology, I suppose I've been doing it. When Rupert was in Hong Kong doing what he was doing, I was working for Montgomery Securities, which then got bought by Bank of America. So I was spending a lot of time going back and forth to California. So I was at the very kind of epicenter of the Robbie Stevens, Montgomery, Cowan kind of tech boom. And I think what's interesting when I look at tech, and I guess I lump AI into this as well, is the difference between disruptors and enablers. And I think it's a completely underappreciated, concept, which is that, you can come in and create a disruptor. 4 guys in a garage in Tel Aviv can create a disruptor. But ultimately, a loss-making disruptor has got to find a way to making money to really be a good long-term investor. And what I like is the enablers. So I think simplistically, when I see a trend in technology, whether it be, it was data centers before, it was then crypto mining, AI is now cropped up, although it actually all went back to 1956, so it's, AI has been around for a while. I think about the picks and the shovels. I think of the platform ambivalent companies that are going to get the orders and create, the opportunity to go and dig the AI holes and do the mining. And so I guess when I look at this, I look at Monolithic Power, I look at EPAM, I look at Arista, I look at AMD, I look, of course, at NVIDIA. But I guess I also look at the semi-cap focus names. And I guess what I try to do is when I think about a thematic in technology, I just try and back off a little bit and say, where is there some reasonably sensible valuation? And where have you got good, decent, mature companies that are going to be around for the long term, that have got decent margins, that aren't, that aren't levered. Well, most tech companies aren't levered, but actually ultimately businesses that have got a survivor bias. I was always a big fan of analog devices because analog devices was a weird entity, just like EMC was in the storage space. And as much as they were based on the East Coast and they were based in Boston. And so they got completely left out of the whole kind of craziness of Silicon Valley. And they used to get great employees because they were 2 of the very big few tech companies that could ultimately employ people who wanted to go and work on the East Coast. So there's some sort of really, I think there's some commonsensical things about this. When it comes to AI, I don't think anyone really knows who's going to win, but I refuse to believe that Google don't have hundreds of unbelievably smart people who've seen this stuff coming down the pipe. And so, when I look at the FANG names, would I rather own Google at a market multiple or less than paying 160 times for NVIDIA, however great a company it is? I guess I err on the side of caution. So, I in a rather long-winded way, that's kind of how I look at this whole.
What about Microsoft versus Google? Because Microsoft so far has benefited from the whole AI run, and it's been the kind of darling of this.
I think GPT has had the fastest. I think it was the fastest. It's 3 months to 100 million downloads, right? So it just goes to show how much time everyone has on their hands, right?
That's
For
right.
one.
Well, I've been using it quite a bit. I've come to the conclusion that ChatGPT is a bit of a bullshitter. I don't know if you've been trying it out, Kev. If it doesn't know, it
I've
tends to
tried
make it up.
Oh, you know, it's funny.
Well, you see, I think
somebody
thing
on my
is,
desk, sorry to interrupt it, but somebody on my desk asked it about me, and it had me going to a different school and being a chartered market technician, which you guys
That's
should
exactly
know.
what I mean.
I'm the last guy to be a chartered market technician.
You and your crayons, Kev.
That's right.
I think when it's given specific tasks, I think there's an interesting, I'm trying to remember what the book's called. It'll come to my mind in a second. But, I think when it's given specific tasks to do, then I think, and it works in conjunction with humans, but I think letting it off the leash and letting it on its own, if you put it into, automatic driving cars, or you put it into missile and target acquisition, which is both places where it's being used in a very big way. If it doesn't have a human interface, it doesn't really know what it's doing. It can do incredible things, but it can't stand back, and it needs the human interaction.
Yeah, I agree.
And I think we were saying that it was originally given in 1956. You have this thing called the Dartmouth Conference, which was the longest continual bilateral dialogue between American and Soviet representatives. And it was given its name, artificial intelligence, but the runner-up was actually called complex information processing. And actually, Rupert made a very good point this morning, which is it would be a whole bunch easier if it had been called that rather than AI.
Ah, yes. No, you're absolutely right. It makes it sound too smart when it really is the complex.
When it's really a bullshitter.
Yes. Listen, one of the things that I'd like to just go back to Rupert for a moment. When I read your letter and I look through it, one of the things that I love about it is the fact that you aren't just saying, oh, I like Australia dollar, I like this, or I like DBA. And you'll actually talk about how you yourself, and obviously it's not advice, it's just you're going through your process of what you're buying, of how you implement these trades. And I think that's really one of the unique aspects, and I think it's really well done that way. But you've mentioned earlier that you're allergic to short volatility, and all of your trades, they seem to reflect that notion. I'd love to just kind of get your, first of all, how you came about believing that you should never short volatility, and then why you think it's important in terms of how you manage a portfolio.
Well, I mean, apart from the PTSD of bearings blowing up and the block trade business out in Asia, I just always felt that being short volatility is a game for other people's money, right? In that, essentially selling vol is typically a yield enhancement strategy where you're short sort of some pretty ugly tails. And just from an actor, I sleep through most market hours. So it's 7 o'clock in the morning here now. I basically only get up during US market hours by appointment. And I really don't fancy the idea of waking up one morning destitute because I was short a bunch of puts on something stupid. And, there are plenty of other investment strategies out there which are, look at risk arbitrage. Essentially, it's a short vol game. And I think, I'm not putting words into your mouth, Kev, but because you were a market maker originally on the sell side, you're naturally drawn to selling what you see as overpriced options.
Well, not only that, as at a bank with a balance sheet and with all the flows, if anyone was going to sell it, like apart from the pensions that can just sit through everything, the next best person to short it is a bank and that somebody that actually is in the flows and can manage those.
Absolutely, and it's a horses for courses thing. I just think you've got no edge as an individual being in the business of selling volatility, and also
Kev, I was going to say that I think that's where I find Rupert and I kind of working together is really useful because sometimes the obvious conclusion is a straight equity long or maybe even an equity short. But very often with something like gold, you can own the physical in whatever currency you choose to own the physical in. You can buy the bars.
Kev, I'm really sorry that Will brought up gold. I thought it's
But
it's the
you know, it's
Scottish
a good
play of
example.
commodities right now. We're not supposed to mention it.
Sorry, we're not supposed to.
No,
mention
no,
that.
you can
But it's a
mention
good
gold.
example. It's a good example of where Rupert can bring the derivative world to play.
Yeah,
You know.
I mean,
We've done it
I
on
think
a bunch of different areas.
In the age of sort of Robin Hood and the degens from Wall Street Bets, I think options have got a pretty bad rap. I mean, I think that I think the way to qualify them is that they're the poor man's prime broker. I mean, where else can you get competitively priced, well, institutionally priced non-recourse leverage on stocks or commodities?
Yeah, no, that's a great way of putting it. I completely agree. All right.
Yeah, and the other thing is, I mean, I also if you spent too much time being a market maker or a market maker or on an institutional sales desk, you get very obsessed with what level of implied volatility you're buying or selling at. I think it's important to understand your Greeks, your gammas, your deltas, etc., but not think in them, right? You're just using options to express a view where you think that the market is pricing an outcome which is more or less likely than you think is likely to happen.
You're absolutely right. The other day I was pricing out some skew because something was, had some skew, and I was like, oh, what's that edge actually in dollars? And I did all the math, and I was like, oh my God, what am I getting so excited about? I'm just going to the delta from this is going to mean way more than the skew. And a lot of times too many people get too focused on little details.
I think it's so. My catchphrase is you need to understand the Greeks, but not think in Greek.
I like that too. Okay. Listen, we're gonna finish up here with some of our questions, and we're gonna start with Rupert. We'll start with your favorite investment book.
Okay, so listen, I've listened to your show for a long time, and there's a program on the BBC called Desert Island Discs, where every guest gets to take the Bible and the complete works of Shakespeare to their desert island. And I think for your show, it needs to be reminiscences of the Stock Operator and Market Wizards. And that's what you're given automatically. So then you have to think up something original.
All right.
And so my one here is back from the GFC. There was a book called Finbar Taggart's Crap Cartoons.
What is it? I don't even know it.
That it's out of print, but you can through those reprinters you can get it now. But
so how do could you repeat it again so we can all look it up?
So Finbar, Finbar, Taggart, Taggit, and it's 2009. Finbar Taggart's Crap Cartoons, and we never know who he really was. We think it was an American working for a US investment bank in London, was publishing on a website almost daily these hilarious cartoons making fun of what was going on in the finance world during 2008.
Oh my goodness. I had no idea. I never knew about this.
It's a brilliant way of reliving that funky time, which we've got some sort of echoes of right now.
Oh, that's fantastic.
But I checked online. You can rebuy this thing for.
That's right. You can go to Blurb.
Reprint it for $28.
Yeah, you can go to Blurb and then you can reprint it. Will, we've already asked you your favorite.
Can I chime in because I've got another?
Okay.
And I think this again is thematic to how I think about the world, and I think a lot has changed since you and I last spoke. And I think that we're seeing with what's going on with the dollar. We're seeing with what's going on with the tragedy of Ukraine. We're seeing what's going on with the alliances that we never thought were possible. We see what's going on with US politics. And there's a book called Prisoners of Geography by Tim Marshall.
Okay.
And it's got lots of pictures in it, which appeals to my simplicity. but it's basically very simply explains how leaders of nations are constrained by geography. And their choices are limited by mountains, rivers, seas, concrete. And it's a fascinating way of thinking about life after Ukraine, life after these conflicts, and how who wins if Russia survives, what happens in Eurasia, and connecting the dots between what happens in Eurasia and being able to get carbon neutral, because all the things you need to get carbon neutral are sitting in Eurasia. And so I think anyone managing money, anyone looking at financial markets, needs to have a macro template to understand how the world is changing, and consequently how indexes asset allocation is probably massively backward looking. And if you get to understand what Tim Marshall talks about, it enables you to actually look at some of the countries. I would single out Panama. I would single out Namibia, both countries I've been to and written quite a lot about in the last couple of months. And you begin to see who the winners and who the losers are. And unfortunately, there's a lot of America that wins and a lot of America that doesn't. But there's some clear winners and losers here. And it's really, as I say, I think it's just a fascinating way of looking at the world. And it's got lots of pictures.
It's got lots of pictures. One of the things, Will, while we're on this topic, and you mentioned the U.S. dollar in there, and I see in your one of your recent notes, you said, honestly, U.S. foreign policy is still in 1990s authoritarian global parent mode. And you're talking about whether the U.S. dollar hegemony is ending. Can you just kind of chime in there and give us your little elevator pitch on that, your thoughts?
I worry because all the debt, all the entitlement is sitting in the West, in Western nations. And a lot of it is in the United States of America. And I think the global South has had enough of being lectured by the United States. And after what we saw was going on in New York in the last 48 hours, I don't think anyone needs a lecture on a functioning democracy from Washington right now. So there is a case to be said that when you combine that with a lot of instability, a high growth and recovering China, and some global alliances that we never thought would have been possible even 12 or 24 months ago, and those alliances having a massive issue with regards to currencies and how trade is done, I think there's just going to be some thought processes behind what your default currency is. And I would just use one example because I think it's fascinating and it's something not particularly known. I was talking to a government minister this morning in the UK, and I highlighted this in one of my letters, which is that there's a thing called the CFA franc. And the CFA franc is used in 14 countries in Africa. And it's basically the French franc. And it goes back to the colonial times of when France controlled places like Equatorial Guinea and Guinea-Bissau. And these countries have all clubbed together, and they're clearly not happy about having a euro franc currency, which sort of almost condemns them to sort of currency slavery. And it's interesting that they are looking and talking to the UK about having this currency replaced and pegged to sterling, not to the dollar. And I just signaled it out as, one of the monikers I say about nut stuff is to make you question and make you think. And I just question and I think about how little we think about the fact that the US is just the default reserve currency. And that's all I'm saying. I'm not sounding the klaxon on the end of the dollar, but I'm looking at how the dollar's behaving. I'm looking at what's going on in the world. And I'm connecting, I think, some dots that aren't being connected by enough people.
Okay, that's great stuff. Rupert, are great traders born or made?
I think you've got to love markets to be a good trader. I think that there are certain aspects of risk tolerance and comfort which you're either born with or you don't have. So it's a bit of both, Kev.
You're probably right there. All right. The Don Cox question. Don Cox was a famous Canadian strategist who always said that you should invest on what's not on what's on page 1 today, but what's on page 16 on the page to one, on its way to page 1. Do you have a Don Cox investment for us?
Well, I knew this was coming up and I really missed physical newspapers. So actually, I've been buying the Australian Financial Review regularly to try and get some inspiration about page 16. The trouble is that the property market occupies pages 1 to about 25. So that was pretty useless. But in terms of my one, I actually want to switch this around, do a bit of George Costanza, and I'm gonna take the other side of Will here, as I actually think that all this discussion about the US dollar losing its reserve currency status should be on page 16 instead of on page 1 right now.
Why do you think that?
Ultimately, I think that it takes periods of hundreds of years for, if you just take the example of pound sterling being a global reserve currency. And I think that, yes, there's certainly some tarnish on the dollar created by, the events of the last 12 months, the weaponization of the dollar by the Treasury and by other Western central banks. But ultimately, there isn't really a credible alternative. If you look at, the Aussie dollar, for example, in terms of FX volumes in Aussie dollars, it's almost the same number as the RMB, right? And we're a small country on the other side of the world with 25 million people. So are we really going to replace the dollar with the yuan? I mean, I just don't see it, or at least not in my lifetime.
All right, Will, do you happen to have a Don Cox, something that's on page 16 that you think is going to be on the page, on its way to page 1?
I so do.
Okay.
And it's a company I've been following for a long time. And I hate to say it, it's actually it was a Russian listed company with a US ADR. And it's called Vion. And it has 210 million customers across 20 countries. And in a lot of places, it is the number one provider of mobile services. And it has been a tainted business because it was the owner of old Vimpelcom, and it had a very big Russian business. And it is in the process of cleaning itself up. And I guess I look at it as it's an essential utility that is clearly needed in Pakistan, in Ukraine, in Russia, etc. But the flip side of it too is I think they're going through a big, huge restructuring at the moment. It's obviously got a kind of can't invest, sort of black cover over it right now. But if I'm right, and I hope that some brutal sense prevails in the next few months in some of the more toxic parts of the world, I think this is a ludicrously cheap telecom stock. When you look at it on an average on ARPU and every single other metric, it's just a ludicrously cheap stock. So it's kind of it's a Rolex watch in a Russian bag, and I kind of think that if they could find the Rolex watch and take it out of the bag and put it in a different bag, it would get revalued.
And that trades on the NASDAQ. I see VEON. Am I correct?
VEON. It's got some liquidity issues, and it's not particularly easy. It's not particularly easy to buy, but it's actually having it's had a good year so far this year. But I would encourage people to look at the valuation, or I write about it quite a lot, so I keep a good eye on it.
That's great. Now, the next question is the Byron Wien surprise. Byron Wien was somebody who defined a surprise as something that the market would assign a less than 1/3 chance of the surprise occurring, but yet he felt that there was a greater than 50-50 chance of that happening. Rupert, first, do you have a Byron Wien surprise for us?
Yeah, I'm going to stay with currencies and a bit from my history and go with the Hong Kong dollar peg, because everyone's screeching about it again. And, I know from my time working with the HKMA, with the Hong Kong Central Bank, that the Hong Kong dollar is going to depeg precisely when the Hong Kong Central Bank decides it's going to depeg, not when some guy in Dallas, Texas or Midtown Manhattan tells him it's going to happen. So I think that the odds of the depegging of the Hong Kong dollar are actually a hell of a lot longer than Bill Ackman and Kyle Bass are screaming about.
I like that. And the thing that always amazes me is if they're actually going to depeg and you want that to occur, the last thing you should be doing is talking about it publicly.
Yeah.
Right?
Exactly.
Like if that's really what you want. Now, you could question whether that's what they want or whether they want to create a frenzy to actually get off their trade, but that would be just speculation on my part. Will, do you have a Byron Wien surprise?
Yeah, cash. Cash. I think COVID-21 or whatever happens, I think there will be a very good fighting chance that we will, for all the excitement on AI, we'll wake up one day and have, I think what happened in Canada last summer with Rogers, when Rogers went down, there was a 24-hour period, I know, when basically the internet and mobile phones and nothing really worked for about 24 hours. And I think that could be when you look at the concentration of undersea pipelines that are essential to the operation of the internet. And so I would encourage everyone to have 1,000, 5,000, 10,000, whatever your spending is, put some cash in your safe. It's very difficult to get cash out of a bank right now, as we know. But I put some cash in the safe because I think you'll wake up one day and find that the grocery won't take a Revolut card and neither will the petrol station. And if you've got some cash, you're going to feel good, and you'll be able to sell it to your neighbors.
That's right. You want to hear a funny story about this, Will? At 9/11, when it occurred, I went to the bank. I guess the second tower went down, and at that point, I was like, "Holy smoke, something's up!" And I went to the bank and I tried to take out a lot of cash, and I wanted Canadian cash, and the Canadian cash they had no problem giving me. But the American cash I wanted to take out was literally like I just cleaned out whatever they had at the branch. And I remember saying to the person, the manager, because they taken me into the back to do this. I said, geez, someone must have beaten me to it, and you must have had a lot of people taking out cash. And he looked at me and he's like, no, you're the only idiot that's come to do this. And it's funny because I tell that story and there's one other trader that I know that did the same thing, and he did it at another branch, the downtown branch. But yeah, I'm with you. We take for granted that all this interconnectedness and that it's all going to work. And if it doesn't work, you're going to really appreciate having some cash. And one of the other pieces of advice I'd give you is make sure they're small bills. Because if you go take out a bunch of hundreds, you don't want that. No one's going to be able to break them. It's going to be difficult. You want
your Krugerrands aren't going to do you much good when you're trying to buy a loaf of bread.
Yeah, so you just want cash. You want as the smallest bills as you can. All right, let's end with Rupert, and we're going to ask him, if you're giving someone advice that's interested in this industry, what advice would you give them?
Well, do you remember when we were growing up in the 80s, we were all told that we needed to learn Japanese, and then it became Mandarin. And then more recently, it's essential that you learn how to code. I think AI has probably shot that fox. But in general, I think it's just all about having an inquiring mind. I ran for a while Citi's graduate recruitment program. It was an exhausting job, sort of interviewing 150 grads over 3 days with jet lag in New York. But it was always staggering, the number of people from good schools reading finance-centric degree subjects, that it was very clear to me that they didn't follow the markets. And if you're coming to go for a job in finance and it's clear that you haven't demonstrated an interest in the very subject matter, you're not going to get very far.
Oh, that's good advice. Will, do you have an answer to that question in terms of what advice you give a young person?
I mean, I think the world needs fewer computer scientists and more MIG welders. It needs more engineers. I think I'd encourage young people, even people who, look out the window. As Rupert quite rightly said, go and spend time in interesting places. Dare to be different. I think that's the best advice to give people.
Oh, that's great stuff. Okay, so let's talk about where we can find both your great letters. We'll start with Rupert. It's called Blind Squirrel Macro. Why don't you tell people how they can find it and just reinforce that for now it's free. So make sure you go sign up.
Yeah, it's absolutely free. So it's Blind Squirrel Macro. I'm publishing it on Substack, where you can find it at arcadianow.substack.com. I write at least a couple of times a week. I publish the flagship piece on Monday morning Australia time, so around the time that futures markets open in the US. And that's a market wrap where I also review the Acorn trades, which are the specific trade ideas, and that's like the Mercedes idea and the AGS idea that we talked about earlier. And then occasionally I do what I call my squirrel ears, which is when I come across a particularly interesting interview or podcast I'll write it up and send a sort of 5-minute read summary to my readership. You can also find me on Twitter at Squirrel Macro, and I occasionally tell my team that they're amazing on LinkedIn if you're allergic to Twitter.
All right, Will, where can they find the nut stuff?
So I write, again, I write twice a week. I try and write on a Tuesday or a Thursday or a Wednesday and a Friday. And then on a Monday, I normally send out my portfolio report, which is the long-only diversified fund that I've run now for 5 years, that sort of proves and has a good sense that, I eat my own cooking. What I try to do in Nut Stuff is also try to refer to, Rupert and I do a bit of cross-fertilization. And so we will, refer to, when we're looking at the same theme, looking at similar ideas, we'll allude to linking to each other. You can find Nut Stuff at www.nutstuff.co.uk. You can find me on Twitter at NutStuffAlpha. And if you go on to www.nutstuff.co.uk, you can sign up and get a 2-month free trial, which will give you plenty of nut stuff to look at and evaluate.
That's awesome. Well, listen, it's been a real pleasure having you both. Thank you very much for your time.
Thanks, Kev.
Kev, thanks so much. Really enjoyed it.
All right, Patrick, time for talking charts. What do we got?
All right, let's go through the top 3 things we were watching a couple weeks ago. The jobs numbers was number 3. Obviously, they started to weaken, but I wouldn't say that this is a huge breakdown, but certainly some of these numbers are starting to miss.
That's correct in terms of the weekly numbers, but in terms of the kind of monthly numbers, we're taping this Friday morning. By the way, how uncivilized is it that they release this on a Friday when it's everyone's
Markets
off
are
work?
closed. It's
and the poor
hour.
bond traders, although I'm not going to shed too much of a tear for them because they seem to take off at lunchtime many days, but they had to come in today. A lot of the Chicago pits were open. A lot of the settlements, there was definitely trading this morning because of this number. Don't understand why. If anyone knows why the government actually releases this on Good Friday, I'd love to know the reason. But it was just in line, Patrick. So although there was lots of folks that were expecting it to translate the weakness that we've seen in the weeklies to translate into the monthlies, we haven't got it yet.
Yeah. So we were also watching that Russell Nasdaq ratio, and it continues to be very, very weak. The Russell continues to underperform the Nasdaq, and that hasn't really stopped. I mean, the regional
I would
banks
agree with you that the last couple of weeks
right?
have been that way, but don't you think I saw on Wednesday, I think was the first day that the Nasdaq actually led on the way down. And I thought that was
take a look at this chart here. That's still pretty weak.
Yeah, you're right.
Right. And but you're definitely right. The Nasdaq did have a bit of a pullback there. Otherwise, we were just talking about banks, right, and just what was going to happen. And while there was really nothing crazy that's happened since then, there certainly has not been a recovery.
Terrible.
Like when
it's
you look
terrible.
here, the regional bank indexes along the lows. The XLF, which is the big banks, did bounce a little bit, but a far cry from anything reasonable.
No, it's the bounce has been anemic, and it's continues to be shoot first, ask questions later.
Yeah. Anyway, so let's talk about the top 3 things to watch over the next 2 weeks. Number 3, we're getting into the earnings season. And it'll be really interesting to see whether or not we see these companies coming in line, or whether we see the economic weakness start to trickle into the earnings. Any thoughts?
Well, a couple of things. One, when we go into the earnings season, a lot of companies are in blackout periods for the buybacks. So we sometimes see drifts down from that perspective. The other thing is that it will be interesting to see if we finally get the pessimism from the bears in terms of earnings. They've all expected earnings to collapse. To me, it feels like there's a lot of bad news baked in here. But it will be all over the map. There'll be some industries that surprise on the upside and some that surprise on the downside. I don't think we're going to see an across the board kind of tendency. How about you?
Well, I think that inevitably this year we're going to see earnings actually continue to decline. But whether this month is the start of it or this quarter is the start of it, I'm not so sure. I am 50-50 on it, but I think by the time we get into the latter part of summer and we get into the next earnings cycle, I would be far more suspect of a bigger downturn. Right here, and it's a 50-50 for me. Anyway, number two, the inflation numbers coming out next week. And obviously 2022, last year, it was all about tracking inflation. But really this year, those inflation numbers have just been continuing to mean revert back down. It's obvious that when you have year over year numbers, there has been nothing that's really driven the most recent anything to drive a recent new surge in inflation. So I think the inflation numbers will just continue to kind of hover in this area or even pull back a little bit. What's your thinking, though?
Well, I think the market is expecting that already. And the real question is whether inflation declines as much as everyone's expecting it to. And if we get a situation where it ends up being a little more sticky on the downs, I mean, in terms of falling, it doesn't fall as quick as market participants expect, it could put the Fed in a real big bind. Because if we do get the economic weakness, as many are expecting due to the credit contraction from the banks not lending and just in general, finally these layoffs on the big tech companies starting to bite, and that is combined with inflation not coming back down as much as everyone would have hoped, it would be just an awkward situation.
Right. And so number one, oil. What a move that was, right?
It helps when the Saudi Arabia comes in, or OPEC, I should say, does that. It was out of the blue.
It's not just OPEC.
Well, what was interesting as well is that everyone had finally gotten short. And let's just pull up the chart if you can, because that was ridiculous. There was no such thing as triple bottoms. Worked again. We had a break below, and then it was the reverse prairie dog. Right.
Yeah. And it's interesting. I was lucky enough for Big Picture Trading members to catch that bottom. I just didn't think that there was a sustainable drop. I wasn't predicting that OPEC was going to flip. But if you now, in hindsight, being 2020, it's one of those scenarios. Is like, are these oil producing countries going to allow oil to just keep going lower and their profit margins getting smashed? It inevitably there was going to be a counter reaction, and they were going to bring things back in line.
Here's a question for you, Patrick. Do you think that gap holds?
Well, I mean, I think that there's vulnerability that we're going to go and test $78 or something, like where it goes and tries to gap fill a little bit. But I actually think that this is a legitimate bullish turn.
This chart reminds me of the Dennis Gartman trading maxim, is that if you buy the third day of a gap that holds. And in fact, to me, I look at that and I see that gap, and I'm actually surprised that it hasn't filled a lot more, and that looks like it's stronger.
There's different gaps. I mean, we can get all into technical analysis much more, but I want to just here on the continuous chart, I want to just show where the significance of the gap. So what I'm showing here is the volume by price levels, right? Where the fair value zones where oil really traded in high volume. And what you can observe is this gap just blew through these zones like a hot knife through butter. And more importantly, is more or less consolidating along the highs. If this ends up being just a consolidation pattern, and we have any one breakout candle on the upside that takes this out of the top end of that range, there's very little resistance for us to be punching $90 on the upside, like on an advance. And while I'm, at this moment, there's no guarantees in the markets, but to me, this looks pretty bullish, bud.
All right, from your lips to God's ears.
It's been a good move actually. So let's chat about some charts. Let's start with the S&P 500. And well, just take a broader look at these markets. And what one of the things we talked about several weeks ago was obviously everyone was so bearish, but to me, and you were just a little more bullish than me. But my view was, well, shit, if the market isn't going to collapse on this kind of headlines, and this is not the moment in the cycle where the market is going to have the next bear market drop, and so there was so many people fearfully on the sidelines or too aggressively short that a short squeeze the other way was actually a very common sense kind of reaction that you would expect. Nonetheless, it happened. I mean, we got a rip almost to 4,200 on the upside, and this chart generally still looks pretty bullish. And without this jobs number having come in line, it didn't derail this. So a continuation of this even to 4,300 on the upside of the S&P. It's just it feels like April's going to be a good month.
I don't disagree, but that's probably why it means that you should be selling it with both fists.
Yeah, well, don't Goocher it, but well. Okay, we're not Goochering it because we actually have two very different views. Because you actually are outright stupid bullish, and you think that this.
No, I've switched a little bit. I'm not as bullish as I have been,
Really?
I'm
okay.
I think that there's a lot more internal. 1 second, I think there's a lot more internal action occurring in the market than most people are giving credit for. And right now it's getting driven by those, Apple, Microsoft, all those big names. And I'm not as bullish on those as most people are. So I think that when you're looking at the S&P 500, it can look better than it really is because of the FANG maps.
Well, let me give you. I feel that where the surprise might be is actually how, okay, so let's just imagine a scenario when we talked about oil a second ago, that actually happens, right? We don't know, there's no certainties, but let's just say oil does break out 82, starts punching 90 on the upside. What's going to happen to the energy names? Last year, they were the massive outperformer. What if that trade starts to work again? Now, if the energy space starts to turn, what if we see the uptick that we saw in all the defensive names? Like, did you see like XLP started to rip to the upside? XLV, the healthcares, had a decisive turn higher. XLU, the utilities, decisively broke. What if actually the advance of the S&P 500 suddenly doesn't continue with the leadership in the NASDAQ the way you're saying, and actually we see the S&P work its way higher and the NASDAQ start to lag?
Yeah, and well, yes, but I think in that environment, the S&P still has too many of those big FANG mats. So it depends on why the NASDAQ's lagging. Is the NASDAQ lagging because the top six, whatever they are, like, the Googles, the Netflix, the Amazons, those are lagging? Or is it lagging because all the other kind of speculative tech names roll over?
Well, I still think the NASDAQ goes higher. And I don't see why the August high around 13,700 cannot be achieved. One more impulse higher on the upside. I just think that at this moment, the market doesn't have an immediate reason to go down. Now, could it be a sell in May and go away? Could it be a scenario where the next kind of 2-3 weeks, the market makes one more push higher, and then maybe earnings derail it? Maybe some other news kind of comes along. Maybe it's the May jobs numbers that finally cracks the market. There could be a number of things that play out, but right now in the short term, it's hard to get immediately bearish. It's looks like there's room for these markets to still keep going higher.
All right, what else you got for us?
We got to touch on gold. Like since we last talked, first of all, last time we were on the show when we did it, it was a big breakout back up towards these highs. It's been an ascending triangle pattern, decisive breakout. Now it really looks like gold. There's not much stopping at this point. I'm going to put on a weekly chart for gold doing some sort of a retest of all the two major highs that it put in back in 2020 and 2022, up around this 2080 zone, which is rounding. And so like gold can easily punch up there. But what will be really interesting is whether this is the moment where the big gold bull market really rips. Now, I've heard some really crazy bull numbers on gold coming from from gold bugs, and while I can drink that Kool-Aid on a decade basis, which is like a big rip from 2025 to 2027 or something, 2-year rip that takes gold substantially higher. I still am reluctant to believe that this is just all upside from here on gold. I somehow my spidey senses are saying that there's going to be some sort of throwback. It's not uncommon for gold when if there was to be some sort of bearish move in this market, when there's like these little liquidity events that gold and silver and everything get dragged down with everything as correlation of all assets goes to one. I'm not so convinced that this is just all upside from here. Are you more bullish?
Well, so I was going to not mention anything and not talk about anything because I was worried that it would be goochering. But now that I see your hesitancy, it's making me feel better. And just I want to pass along a story of our buddy Cuppy. Cuppy is a huge bull, and he's tweeting about it and talking about it. And it just, all the pushback is amazing. And if there was ever a Don Cox situation, and Don Cox says those who know it best love it least because they've been burned the worst, I feel this is it. Even the gold bulls that are long are expecting to get hurt. Nobody likes it.
No, listen.
But you I get it. You're not shorting it, but you're still not. Like, you're not as bullish as it might be if you just looked at this chart. And so I guess that's the point.
Example of how how I'm going to be playing it is that if we saw a surge up towards like 2100, I would just load up on protective puts and bite the bullet that I'm giving back a chunk of my gains.
Okay, that's fair enough. But there's still some skepticism there, and that's my point. And let's just put you aside for a second. The comments in terms of when Cuppy tweeted about it and when I talk to people, even the most kind of bullish gold bulls are expecting to get hurt. They don't believe. Nobody believes that this is it. There is nobody saying like, yes, of course there's going to be the Peter Schiffs of the world. So let's just put aside because they always think that. But the people that are actually willing to change their opinion, very few of them think this is it and gold is actually going to continue and break out.
Yeah.
Anyways, that's just my kind of feeling about that.
Well, it's when you put this on a weekly chart and you step back, right?
If sure looks like a triple top, and we know that's something that just traders, parents tell their kids when they're little traders to make them feel better.
Yeah,
no such thing.
Inevitably, at some point in the next 2 years, there's going to be a rip. And it probably is north of 2,500, maybe going to 3,000. The only question that I'm debating is that does it happen here in the second quarter of the year?
Okay.
And I view it that gold is going to make that move. I'm just not so convinced that it all's upside from this very moment.
Yeah, listen, it's extended. It's up against the number. There's going to be a lot of people looking at that triple top, leaning against it. If all of a sudden the bank crisis goes away and we get a situation where the Fed's not hiking rates, it's easy to see how it would happen. Sorry, not hiking rates, not lowering rates as much as everyone thinks. There's a lot of expectations in the market for the Fed to lower rates. And if that inevitably, like if the economy doesn't roll over as quickly as people anticipate, we could have a situation where actual real rates tighten, and that would be heavy on gold. Like, I understand the argument. You can make, I get it. It's easy to make the argument that gold is actually due to come back in. I just think, for me,
I'm in that camp. I'm in that camp.
To me, I think it's a bull market, and it's in a bull market because central banks are diversifying into gold, and it's a tiny market. And although I understand the argument, and I fully expect it could go back down $100, I'm willing to live with the maybe down $100 because I think that the next 1,000 is up.
There you go. Next thing, I wanted to talk about the Widowmaker.
Oh, God, this thing's awful, eh?
My God.
Nat gas.
And
Optionsellers.com.
I have cuts all over my hands trying to catch this falling knife.
Well, I'm missing fingers, buddy.
Yeah, I'm for fuck's sakes, right? Like it's actually crazy. Seeing the bleed out, right? I mean, the contango is insane. Like, look at that little blue. That's easier just to see it here, but you can see. I mean, the majority of the term structure lies in the $4 to $5 range, but there's such an abundance oversupply on the very short term that's jamming spot so low that there's this ridiculously steep contango. And what's crazy about that is that those trying to buy the bottom of this with the UNG, unless the UNG bounces here and that contango disappears, it's going to be a painful roll up that term structure.
Yeah, and so is UNG the one that's only one contract?
Yeah,
I think it
still
is
at the front,
and that,
so like if
that's
the front
actually
doesn't
really
bounce,
scary. And I'm just a little heads up in terms of those who are playing natural gas from UNG. Go and make sure you understand the risks you're taking with that product, because we could have a situation where the front month theoretically could go to zero because of all of a sudden oversupply in 1 month, and then we have the rest of the curve trading at $4 like that.
And then the ETF rolls up that freaking contango term
but
structure.
the ETF could get zeroed. It could go theoretically if the
I mean,
month
you're
went
talking
to zero,
about a repeat of the
USO,
sort of the USO and when crude oil on the front month.
So
but I'm shocked that they didn't start buying the term structure.
Oh, I don't understand why they're still rolling the 1 month. There's just way too much volatility. If there was ever a contract that was designed to be owning all the different months, it should be this. Like when I trade this, I refuse to trade just like 1 month. I go buy the whole strip. I will, if I do natural gas, I buy at least 12 contracts. Because I don't want the risk of 1 month. I want to reduce the risk of 1 month. And for those who are saying, well, that's big, you can go and there is a mini. You can go trade them smaller. There is a mini futures
the other
contract.
thing you've done was you just skip every second month, right? And you go.
Yeah, or you don't need to do exactly. Because I'm scared. I'm scared of the fact that UNG has all their contracts in 1 month. Now, granted, if it turns, it could turn. It just means all the more.
It could be a double.
Yeah, and that's why
it's violent. It's violent volatility. Like that's what you're signing up for. And the crazy part is not even leverage, and it has that kind of volatility. Yeah, it's insane.
It's that is the Widowmaker, as the optionsellers.com found out. Think of all the pickup in the yield you can get if you short options.
There you go. Quickly touching on copper. To me, this is a make it or break it at this $4 level. So far, it's failed to make a higher high in the sequence. But if it can hold above $4 and get above this 410 highs where it was here in the last couple of weeks, then maybe we might get a bull breakout. It's been just a grinding consolidation. Just nothing. Just crazy, eh?
It has been disappointing for a lot of the copper bulls. I'm wondering what you think about the miners, because to me it feels like the miners are starting to trade a little bit better, and maybe on Freeport.
We'll use the COPEX as the ETF basket, and yeah, for sure. Like this was a classic fib retracement turning up. They do look way better than copper, and that's the whole point. If copper busts 410 on the upside and makes that higher high, this thing will be double top testing 42 and potentially setting up for even more gains, right?
Yeah.
What I wanted to now talk about is this uranium. This is the Sprott physical uranium, and what's interesting is that this thing is clearly there's some big player that's unloading, because when you look at this is just Numerico's tracking of the unit versus the actual spot price of uranium in orange, but we're selling at a discount. Like somebody, this is just somebody is hitting the bid and unloading, and it's not tracking uranium. Do you have a comment on it? Is there something I'm missing about the way I observe it?
No, I think that's a little bit of a hedge fund hotel. And when you get a situation where hedge funds get under pressure, which would happen because of the banks and the blowing out of a lot of different positions, that at the margin they reduce risk, and therefore there's the spread blows out. So it's a discount to NAV. It's at 12% right now, and that's about where it's bottomed.
Do you usually fade these? Like that's
yeah. So for me, I like buying 12s to 15. When it goes to a discount, and then when it goes to par, and everyone's telling me that this is it. I sell it. So I do like.
So you're
that.
exactly what the opposite of the gold trade, which is everyone is going to the highs. Everyone's saying it's going. You're the one that's saying it's going higher. Well, anyway, whatever. I'm not gonna. We'll leave it.
I just think that I think you should, if you're trading this, you should be very aware of what the discount or the premium to NAV is. You should be tracking it and watching it. And when it looks like the worst is the time to buy. So right now, go back to that chart if you could on the discount to NAV, or like the NAV versus the actual underlying.
I closed it.
Well, the long and short of it is, if you look at the underlying price action of uranium, it's gone sideways. So even though right now we have a situation where the U.UN or the spot looks bad, it actually, it's not that big a deal, because the uranium, which it's going to eventually track, is fine. It's looking good. Fine. So don't get too hung up on the technicals of the U.UN and get kind of freaked out by the fact that it's down, because to me that's more a reflection of risk taking than it is the underlying fundamentals of the uranium. And so the uranium, which is the orange line in this chart, that's fine. It's looking fine. It's looking high. It actually looks like it's headed higher.
Yeah, the what I try to talk to my members about at Big Picture Trading all the time is, you have to step back and ask, stop staring at the P&L moving and the market value of your portfolio moving up or down. You have to really kind of look at not only the macro and the fundamentals, but the technicals, and generally say, is there anything really wrong with the trade and the thesis I had for getting in? Because a lot of traders can easily spook themselves out just because they see a red downtick, and yet there really isn't a reason to abandon it.
Yeah. Well, sitting on an institutional desk and actually getting the flows, I can tell you lots of times client just needs to sell something big, and it goes down because of that. And it's not that they're so smart and know something. They just needed to sell it. And that's all it is. So to me, when I look at U.UN, I'm not overthinking it. I'd be a buyer down here.
So I want to just wrap up by touching on the 10-year bond futures on the bond notes, and they were trading up into around this 117 level going into the jobs numbers, and really that it was a make it or break it, because if there was a proper miss on jobs, that could have ripped bonds here. But really, by them coming in line, here comes the fade. I at this stage, this might be a 1 month trade range coming in here, going back down to 114 and just whipping around. Obviously, the inflation numbers next week could be a mover, but I think the jobs numbers was the one everyone was waiting for to see whether or not to take bonds to the next level. And with them coming in line, I think that trade range is coming. What's your thinking?
Well, I think the bond traders would would welcome a little less volatility. So if we do get a situation where the things start to settle down, though, it'll be welcome for them. In terms of the price action,
Yeah.
I'm not sure. It's all about the curve, and there's lots of weird things happening.
A lot of people got very excited about this steepener on the 210s, but to me, the real period where where the steepener clears zero and goes much higher really is when Powell buckles and is forced to start easing on interest rates to some degree or another. I think that this was obviously the financial regional bank crisis kind of spooked bond traders. But think of it, the entire last month of price action has been contained in the 1 day reaction to those regionals blowing.
Oh, that's a good point. Yeah. But it just goes to show you how violent that first day was.
Well, that was like, if you're a short-term interest rate trader.
Yeah, no, this is.
Like,
I think
if you were on the wrong side of that, you're.
I think a lot of stock traders or people that don't trade the front end don't underappreciate how violent it has been in terms of those
the amount
moves.
of leverage that a lot of interest rate traders lean into. It's you almost can't trade the front months without a high degree of leverage because there isn't enough movement if you're just
and I think that they were so sure, Patrick, that Powell was going to continue tightening, and they made so much money on the short side in that were all leaning so heavily short for the front end that when we had a situation where it finally looked like it changed, it just everyone for the exit at one point. And now we're just trying to figure out where we're going to go from here. And it's still extremely volatile with very little liquidity. And there's lots of uncertainty around Fed policy.
All right. I think that's enough for today.
All right.
Was there a chart that you wanted to look
at? No, it's okay. This is your segment, bud.
All right. Let's move on then. Skin in the game, bud.
Okay. What was that evil Ernie laugh? Patrick wins one again. 2 in a row, I think. Maybe even 3 in a row. So you got me on the yen. You know that I have a soft spot for the Japanese yen. And it was the USD JPY was to close under, and I chose under 131, which was yen strength, and it looks like I'm going to lose. We're taping this Friday, but I'm going to concede it that we're not going to go 1.2.
Yeah, the reaction on the jobs was an uptick in the dollar, US dollar there. So at this moment, I've got a full, over 100.
Okay, so I'm going to concede it. So how many points did I lose there?
I think it was 3. Right, so Lena updated here.
Oh yeah, there we go.
So
you're close.
It's
31-32. It's a horse race now. Okay, I don't have my script to read the rules, so everyone knows them anyways. What do you got for us this week?
You know what? Let's do gold.
Oh,
all right. So here's
It's extended to the upside. You make sure when you're setting your price.
Shh. I'm going to give you 2-to-1 odds Sorry. We'll do
two pays one or one pays two.
Two pays one, exactly.
Yeah.
About gold breaking above to an all-time high in the next 2 weeks.
It just has to tick there.
Yeah, it just needs to trade at an all-time high.
Which contract? How are we going to define this?
Are we
going to do cash? Like cash?
Yeah, we'll just use this is a continuous a chart.
Well, no, because there's different. I need to know because there's different.
No, this continuous one. This one right here, which the highest here it traded was back over here where it was 2,089 spot 2.
And I get 2 to 1.
Well,
yeah, okay, I'll take it. I'll take it.
You'll take it?
Yeah, so it's a one touch, right? Like it just as long as it takes about.
It just needs to print. It needs to
okay.
In the next 2 weeks print above it.
I'm all over it. I'll take it. What do you want to do?
3 points. So 3 by 6.
Oh, I like it. Okay, you're on.
All right.
What was that?
What was that? That was that you?
No, it must have been Lena.
That was the perfect timing of it. No.
That was me. My microphone.
All right, good for time. It's time for Lena to hop on anyways. We got no stupid questions.
So no stupid questions. All right. Lena, save us.
Yeah, things just got really interesting with those points there. But anyways.
You were just floored. You were so excited by the bet.
Yeah. I was like, finally, we're taking risks. Hello, guys. Love the show. Can you please explain whether there has been any impact on the implied volatility curve due to the prominence of extremely short dated options, totally dominating broader option volumes? One would assume that enormous bid for these instruments would cause an inverted kink at the very short end of the vol curve, but I haven't seen that. Am I missing something?
No, you haven't. You're not missing anything. There has been an effect. Jem Carson, I would suggest you go back and listen to when he was on the show. He went over this in extensive detail. His argument is that what's occurring is that option buyers are increasingly using these products instead of buying 1 3 month, whatever, previously short dated options. And so therefore what's happening is that there's less of a bid at the farther end of the curve. Now, in terms of how you price these are much more subject to the day-to-day expectations about volatility. So I don't think that you can really, when you're talking about the kinks, I guess what this listener is asking is like, if there's so many people buying these things, why aren't we seeing implied volatilities at the front higher? It's, I guess, because the reality is that actual volatility in terms of the realized volatility is lower, and those two have to be arbed out, especially when it's on a day-to-day basis. So hopefully that answers it.
All right. What is interesting though, Kev, like when the regional bank crisis started, the VIX did spike north of 30 within days. So it's not like monthly or 30-day volatility. It doesn't have that response. Maybe it's been muted a little bit, but it didn't disappoint. I mean, it did what it was expected to do.
I agree. Jem he sees the flows, and he definitely argues there's less of a bid for longer, what were previously called short dated options, but now would be kind of mid options, I guess, 1 to 3 months. He says that a lot of the players that have traditionally bought protection there are playing increasingly at the front end. That was my understanding of it. Anyways, I would though say the fact is that those daily options are much more because they're only daily. They don't have the ability to be bid too much higher than realized, because once they get way higher than realized, within the day it gets arbed out. So therefore, I think that kind of relationship between where the realized has been and where those things are bid is tighter, then like a 30-day implied volatility can be higher because there's still a lot of risk in terms of you don't know what the vol will be over those 30 days. Anyways, that's
Right.
my feeling about why the front end isn't higher implied than the farther end.
Okay. Lena, next.
Next question. Hi, gang. In order to stop blowing up my futures account with a liquid OJ, I've decided to start learning technical analysis.
Oh God, he's doomed.
I've done a deep dive into DMARC indicators. If I use DMARC indicators, then should I also be using Fibonacci's retracements, 50-day moving averages, etc. as well? Is Patrick selective with a few crayons to avoid contradiction, or does he add everything until he gets a shade of brown he likes?
Okay, so Patrick, tell us where the bad
first of
eyes
all,
and all the different voodoo magic comes into part here.
So first of all, I wouldn't call myself an expert on DMARC. I'm aware of its existence and how some traders use it, but I don't feel I'm qualified to either condone it or shit on it. But in a general sense, I feel technical analysis is an important component in an big way of looking at the markets, because when we look at macro and fundamentals, it tells us like what's going to happen and why it's going to happen. But observing the charts, it tells you when it's happening and where it's likely to go. It allows you to build a framework from which you manage risk, admit that you're wrong, plan where to take profits. All these different things happen with charts. Things like Fibonacci retracements, 50-day moving averages, all of these different indicators are just valuable tools for you to construct that framework. And so, I condone the use of that, but you should never lose sight of being able to put it in the context of a bigger theme. It's not just the squiggles.
All right. Next question.
All right.
Hi, team. There's a lot of BS cocktail talk floating around at the moment. What's the point of having an opinion on anything? Aren't we better to tune out the noise and let the price action tell us to trade? Cheers.
I would just have to repeat exactly what I just said.
Well, listen, I actually agree with this. That even though I am one to kind of fade the market at times, there's other times that the market's telling you something, and when it is behaving in a way that people aren't expecting, and I go back to that Bruce Kovner quote, he said something like, "Is what I look for is a market price action that's not confirming consensus." And I think you just have to look, even though I can't stand
a perfect
tech.
example of that is when the regional banks were breaking and the S&P 500 and NASDAQ wouldn't have any of it.
Well, yeah. And the other one I would say,
like
Patrick, is that the NASDAQ, like to me, that thing, I hate it from a fundamental perspective. I don't see why they're going higher, but they are. So for me to sit there and argue with it is kind of dumb.
Yeah. All right, next.
Dear Kevin and Patrick, thanks for all the good cheer and smart ideas. Surely the ultimate doom porn question, and short and snappy, is the U.S. broke? Many deep and esteemed economic thinkers, such as Senor Kupperman, thinks that the U.S. runs a structurally escalating budget deficit with no politically realistic way to rein it in. Are they right, or should I go back to zero hedge and wait for the Great Reset? Side effects of answering this question may include a fourth turning stomach, a nasty gold bug, and uranium or pink eyes. P.S. There's a great bit from Druckenmiller at Seeking Alpha last year on YouTube about U.S. debt. Could be a good bit for the new VWAP segment. Thanks again and all the best.
Can I jump in? Can I go first, Patrick?
Yeah, go.
So
I know exactly what you're going to say. But go on.
Okay, well, why don't you go ahead and tell me?
No. You do it. Go.
If you go back to the 1910s, the 1920s, the 1930s, the 1950s, the 1960s, 70s, 80s, there has always been all sorts of doom porn out there about the size of the U.S. debt. And I think that although it is an influence that you need to account for, you need to be careful when folks say, "Oh, this is it. This is the great reset. This is the time when it finally kind of comes in and it's all going to get fixed." This you just go back to 2010, we had the same argument, and then 2000, and there's all sorts of just constant doom scrolling about these things. Now, at the same time, when the debt does get too high, it is more likely that you will get inflation, which will end up inflating the debt away. But it doesn't need to be this all or nothing. It could just be that we get a decade of 5% inflation, and go figure out what happens with 5% inflation to debt. A lot of it gets reduced. And so, although I understand all the arguments, I push back to the idea that it has to be this cataclysmic, kind of one event thing where it's all going to end. It could just be that this pushes along, and it's just an influence that you need to take into account when you're thinking about the macro events.
Now, my little thing that I want to contribute to this, and this is why I'm a huge fan of price action and technical analysis, because when you hear all of these people make these bold predictions and talk about how everything is going to hell in a handbasket, well, over a long enough time period, inevitably they'll probably be right. But the problem is exactly like you're saying. Is it going to be 2050, 2070, or is it going to be tomorrow? No one really knows. There was in Hedge Fund Wizards, I'm trying to remember which guy said it. I apologize for not remembering who it was that said it, but there was this idea is that it's not about predicting that inevitably it's going to rain. It's recognizing that it's raining right now. And so all these people that talk about all these things that can potentially happen or will inevitably happen over a long time frame, there's no trading framework you can put to that. The only thing that matters is what the market is doing right now and where the money's being made and where the money flow is going. And that's where money is made. And you have to focus on being right about what the market is doing and not anchoring too much on all these stories.
And I guess I'll push back a little bit as well, Patrick, and say that if you went back to 1990, let's say, a lot of people would have been saying the exact same thing. And yet when we talk about the good old days of America's dominance, it was from 1990 to 2008 or whatever. And there's all sorts of examples like that where at the time there was all sorts of pessimism, and it ended up being just fine. So you said your argument was that it'll eventually happen. I don't even buy that. I think that it's an influence that you should understand, but that it doesn't mean that there's going to be some event that causes some sort of great reset.
All right. Next question.
Hi guys, good show. Since that Patrick's other podcast
it's only good. Not
turned,
great.
turned
Damn it.
into
Well, why do
Acceptable. It's an acceptable show.
Since that Patrick's other podcast has turned into a weekly show of beer porn, I have to ask, why do financial commentators sound smart and get so much airtime if they are bearish? Rubini, Grantham, and Rosenberg keep wondering everywhere, telling how everything is getting worse and bubbles will blow up soon, and have been doing the same for decades. And no one talks about their greater than 90% prediction failure rate while
laughing, I'm assuming.
Oh, while laughing at Jim Cramer like he was Cosmo Kramer. Thanks for everything.
This is easy. It's because people are attracted to the doom story. It just, you sound smarter. It's like having an English accent. It's true.
It's true.
We had two geniuses on, like they had the English accents. It just makes you sound smarter. It's people are attracted to it. It's I think it goes back to the Kahneman when he talks about our survival instinct and how we're designed to worry about things, and it just ends up being a better story.
I also think, though, Kev, in fairness, when you are, let's say, in the industry, most people are on the sales side of attracting clients, wanting to get assets under management. And so they always are telling a positive story. Look at the returns you've made. Look at how amazing thing it is, or these stocks did this well. And what happens is that when someone gives a bearish perspective, it seems fresh because the industry is so much on the sales side, just selling everything through rose glasses or whatever the term is. But it's maybe it's just the fact that people like to balance things out. No,
Well, I don't agree. I think that there's a part of us that is attracted to.
Well, I agree with that.
It's like looking at a car accident when you go by, you just can't help it. And I think that it's I will give a little dirty secret though about doom porn. There's a fellow I know that is a big guy on FinTwit. He's very bearish. He gets picked up on Zero Hedge, and when I talk to him and I ask him, like, how have you managed throughout these years, because he manages money for, being so bearish, like, how do you have any clients? He goes, well, tell you the truth, I actually use like a timing tool and by one of the big firms out there to make sure that I'm in the market when it's going up. And it just kind of shocks me because here he is spouting all sorts of really bearish stuff, but yet what he actually does, he recognizes the market.
He's using technical analysis.
Well, yeah, but he's realizing the markets go up on the whole, and then he doesn't want to be fighting it. Yeah. So it just
God, he sounds like a smart guy.
Just be careful, because just because someone sounds bearish doesn't mean they're that smart. Just like being English doesn't make you that smart.
All right, there you go.
All right, 100 words or less.
Okay, first of all, Lena, let me interrupt you. First of all, I wanted to thank all of our listeners for actually listening to what we said last time, which is we said that they have a better chance of having their question answered if they can keep it to 100 words or less.
Oh yeah, that's right.
And they all came in nice and short.
Oh,
and it's
wow.
like, well, first of all, thank you. It makes it so much
Patrick's
easier.
surprised anyone listens to him.
I'm like, what people listen? No, anyway, okay, go on.
Best way to buy or roll futures you want to hold for a while that don't have a big contango, like SPY or gold futures. What's the pro or con of just buying a December contract versus rolling these ones monthly?
Do you want me to do this one, Patrick?
Yeah.
Okay. Is this listener talking about futures contracts, or they must be, right?
Well, I think he meant S&P 500.
Right. He said SPY, yeah, but it must be S&P 500.
He's talking the ES.
ES, right.
Spoos.
Okay. When you're rolling the futures, it would be so let's just take the SPY one because it's easy. It's how you measure it is basically the interest rate that you would pay in terms of borrowing the money to own the stocks over the period of the future minus the dividends expected. So if you actually go look, I think that there's people that are making a market in, let's just say, December 2024 contract. Though there will be a market there. Now, it won't be very liquid, and what'll happen is people will be estimating what the roll is in terms of how much they're going to have to pay to borrow, and then the dividends. So the more uncertainty, the kind of greater mispricing there could be. So when it comes to that, unless you had a real view about dividends or you had a real view about interest rates, and then I would argue that if you had a real view about either one of those, there's better ways to play it. But it would make way more sense to just go and roll it quarterly. It'll be almost the same return. It'll in essence be the difference between owning a 1 year interest rate versus rolling a 3 month over and over. In terms of gold, it might get a little more spicy.
There's a storage cost.
Well, it's not just that. It might get a little more spicy in that in the S&P 500, there's really no limit to how many contracts can be created. Yet in gold, we could have situations where there's a delivery problem. And so there could be times in the future, and we've seen this in platinum and palladium. And did we see it in silver? I don't think so, but we've definitely seen it in some of the other white metals where we had delivery issues that meant that it wasn't just a function of interest rates and storage costs, but actually delivery issues. So I'm hesitant to say that it's as simple as just rolling your gold future every month, because there might be a day in the future where we get into a delivery issue and we have 1 month of gold trading 2, 20, 30, 40, 50 bucks higher than the rest of them because of a delivery issue. But assuming there was no delivery issues, it would be the same as Patrick said. It's merely a function of interest rates and what it is to insure your gold or store it at the actual vault. And it's that simple. So if there was no delivery issues, then it really wouldn't matter. You could just roll into the most liquid futures. And just to be clear, almost all of the people that are fundamentally long or short futures contracts, that is what they do. They just roll from one kind of liquid market to contract to the other. And there's only a few one where you have definite storage problems like natural gas or cattle where that isn't the case.
There you go. All right. Lena, where can they submit their questions?
So if you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
Now, I just want to highlight, again, that was fantastic. It's great when there's 100 or less words in the question. Better chance that you're going to have your question answered. And those of you that submitted the side effects, always a bonus for getting that question answered. So a great job, everyone. Anyway,
Thanks,
Kev,
Dan.
why don't you take it to the close?
Thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow on Twitter at the Market Huddle. We're there every day. Lena gets tired of talking to Patrick and myself, so please give her a shout out. You can listen to Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. And please, if you could, rate and review us on iTunes. We appreciate it. Patrick, where can they find you?
You can find me at bigpicturetrading.com and follow me on Twitter at Patrick Serezna. Kev, where can they follow you, buddy?
Well, they can go check me out at themacrotourist.com. And listen, I actually set up a new thing. We have a great group of folks that are chatting with us there on Substack chat. And I think if you go to themacrotourist.com/chat, you'll actually be taken right there. So come and say hi. I'm always, interested in chatting with different people that want to talk about markets. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. So now stick around for the after show. All right, Patrick, you got to give us a beer review.
You know what? I am a huge fan.
Oh, really?
Of
beers?
Of Brut. I love whether it's a nice sparkling wine or whether it's a Brut beer.
So I'm going to show how kind of uncultured
dry.
I am. What is Brut?
It's dry, like it's dry, not sweet,
Oh.
and it's delicious. Delicious. It's I'm giving this like an 8.5. I loved it. I would drink it again, over and over again.
Okay, so
And it's
I Googled this. Okay, and so Patrick is right, which is surprising.
If it's about alcohol,
Yeah, that's right.
it's usually right.
I did appreciate the fact, Lena, that you put a 12-pack in the image because
the only way you'll
clearly
buy it.
it's sessionable beer. So it makes sense that we put a 12-pack and not a single.
They can also be somewhat cloudy. That's what they say. Well, anyways, Brut
Whatever
beer,
that
the
means.
true
Yeah.
champagne among beers.
There you go.
Very dry,
It's,
high in alcohol, Belgian beer.
Wow.
I'm gonna have to try one. I'm
It's,
upset I don't
it's,
have this
it-
one. Although it is
Yeah,
10 in the morning here, so it is a little
Yeah.
early.
You don't want beer in your coffee.
I'm not Patrick. So Does anyone watch anything good? I finished The Last of Us.
Oh yeah, that was good.
Yeah, wasn't it? It really.
Oh, that was so
did you
good.
find it just got better and better?
Yeah, I can't wait for the next season.
There's another season.
Wow, I'm assuming there will be another season.
I watched this whole video about how they filmed it in Calgary and all the different places. If you're from there, you're literally the whole time you're like, I know that spot. I know that spot. They filmed it, or Edmonton, like one of the scenes where they go in and somebody dies
Ranch or whatever.
Dies in like early on in one of the episodes is actually the Edmonton legislature.
Oh,
It might be the Alberta. I'm not sure. Is the Alberta legislature in
something
Edmonton?
Canadian.
No, I guess it would be. I should know this. Yeah, no, it's fascinating. So if you're from Alberta, or if you're at all interested, go Google like all the different places in Calgary and Alberta that The Last of Us was filmed, because it was exclusively there.
Oh,
Like the whole, like someone goes through and he like finds the gas stations and they built towns. It's kind of fat. It's actually neat to see what they did as well. Like sometimes they just went into a parking lot and built the town from scratch.
Oh wow,
Yeah.
that's
Yeah.
pretty amazing. Yeah,
That's
it's a
cool.
really good show. I liked it.
Have any of you guys watched the UFO projects declassified on Netflix?
No.
Patrick,
Top secret UFO
I thought we were
projects.
I thought we talked about making you less like kind of tinfoil hattish. And
Well, no, I was
working on your.
I just wanted to highlight. No. Listen, I only watched 2 episodes, and I have to say I was disappointed. So before before you give me my tin foil hat, it was. I just couldn't get into it. I couldn't get into like the all of these stories of the thing. Like I don't know, maybe people are gonna shit on me for it, but like it would, I couldn't watch anymore. I
You gave up.
abandoned it.
Out of all the shows you could be watching
Exactly.
on Netflix, you decided to choose that one.
Yeah.
It just shows you
Very on
exactly
brand.
what
Very on brand. I'm pretty sure that those aliens took all the gold from Fort Knox too.
Yeah, they probably did.
You know, there's no gold in Fort Knox, Patrick. The
'Cause
aliens got
took
it.
Well, makes sense. They're keeping it in storage for us.
Okay, by the way, I wanted to talk about something. I briefly mentioned it when I was getting interviewed by I was getting interviewed when I was interviewing Will and Rupert about this Chat GPT. And the boys on the desk put who is Kevin Muir, and I got to read it to you because it's pretty funny, Patrick. You're gonna get a good laugh out of it. Kevin Muir is a well-known Canadian financial analyst, trader, and writer. He's the author of blah 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 blah. Okay, he has over 30 years experience in the finance industry and has worked for several leading financial institutions, including RBC, which is correct. Okay, Merrill Lynch and BMO. Okay, like where they got this shit is beyond me. Okay, I have never worked. I worked for RBC and then I went and worked on my own. So that's it. He has also worked as a derivatives trader at a hedge fund. Not really true. And has served as the chief investment officer for a family office. You know what? I'm to call me a family office is wrong.
Yeah.
I'm not the
funny.
chief investment officer for anything. Anyways, and this is the part you're going to get a real kick out of, Patrick. Muir is a chartered market technician.
What?
Yep. They just make shit up and holds a Bachelor of Commerce degree from Queen's University in Kingston, Ontario. I went to UAT and have an economics degree. It's like,
the fuck?
It just makes shit up. He seems like a Queens guy.
Maybe there's another Kevin Muir out there that's in the finance industry.
Yeah,
Like
maybe.
your name twin or whatever.
My name twin he's a CMT. Maybe you could replace Patrick, that Kevin Muir with me. With that Kevin Muir.
That's funny.
Are you a CMT?
Yeah.
Oh, you are. Well, like, what is it? What's
Mike, you're supposed to say my condolences.
No, I was trying to think of something witty. What's involved with the CMP? Like, how many exams?
It's a 3-year thing.
Do they give you a full box of crayons every year?
Yeah, absolutely. No. No. Just the crayons at the end. Crayons are only allowed for the people that
graduates.
actually graduate.
Oh, that's right. The golden crayon pack.
Yeah, like it's.
Oh, I'm just kidding.
You,
For all
you,
the
you can't.
CMPs.
No, but you can't give crayons to just a first year person. Like,
Yeah, that's true.
They,
It's much too
They haven't
dangerous.
earned the right to draw the crayon. But
They need to see your
that's not
commitment.
true because I've been on Twitter, and so there are plenty of people that think they belong with a crayon box, and they shouldn't.
You know, I love all the chartists. Actually, when people meet me, they're like, "Wait, I thought you hated all that. I thought you didn't believe in technical analysis." I'm like that. What's that line about at the bottom of the ocean are a whole bunch of traders who didn't boats who didn't believe captains of boats who didn't believe in charts.
Yeah.
Something like that.
Okay.
You could also say at the bottom of the ocean are a whole bunch of captains of boats
People that use charts.
who used the charts.
Yeah, that's
You pick
actually
whatever
probably
you
more
want.
accurate.
Okay, well, listen, it's Good Friday.
Oh wait,
and
I needed
Lena-
to mention something. There was our listener Randy that wrote to us at the end of February. I'm just gonna read his email here. Last Friday, so this is back in February. Last Friday, my trading partner, office mate, and my best friend Lucy made the decision that Friday would be her final market close. This is his dog he's talking about. She, however, never cared how the trading day had gone, win or lose, only that the bell had rung and now was the time to play and walk and check the mail together. Listening to your podcast has become part of our weekend routine as we did errands, gardening, and chores together. So listening Sunday, I found a respite and a few hours of normalcy in a weekend that was anything but normal. So simply thanks, and I hope we can toast to her at a close sometime.
Oh, there you go.
So
Well, cheers.
Cheers to Lucy and Randy.
Here's- Thank you for writing in and sharing that. And I'm not crying, that's you.
All right.
All right.
Anyway,
Thank you for writing
have a great
in,
weekend,
and everyone. Have a
everyone.
happy Easter, happy Passover, and enjoy your long weekend. And we'll see you in a couple of weeks.
Okay. Cheers, everyone.